Hello, everyone, and welcome to another hour of Fool24, now being broadcast live on YouTube Live, as well as with our members at Fool.com. So I want to welcome both our new viewers from YouTube Live, as well as thanks for sticking around from all Fool.com members and Motley Fool members. My name is Tyler Crow. I'm coming to you from Tbilisi, Republic of Georgia, as the nomadic contributing fool here. I have with me Danny Vena, the Hawaiian shirt enthusiast, always coming with some fresh threads every single time we do a show here. Always excited to do this. We're going to be doing some earnings reactions because this was like Danny's second Christmas with Nvidia earnings yesterday. I'm sure he has some thoughts on Nvidia and perhaps a couple other companies as well. Before we do get started, I want to just make sure that we are going through our normal disclosures to remind you that we are here to share our experiences, our thoughts, our views, our, I guess we'll call it expertise, but staying humble. I don't know how much of an expert that would be, and so please don't misconstrue what we're saying as personalized information for you. If you do have, if you have personal questions about finances, about individual companies, and how that would affect your financial outcomes, I would implore you to talk with a financial advisor or something like that to get that personal advice you're looking for. Also, Danny and I are contributors to the Motley Fool. So if those of Fool.com who are members, are Motley Fool members, please keep in mind that some of the views we may share may not necessarily reflect what is going on in analyst recommendations in Motley Fool services, and we can. Just in case we may say something slightly different than recommendations are saying. If you want to get any questions in, please go to sli.do with the code Fool24. And we have moderators, so all we do is just ask to keep it civil, please. Danny, how are you today?
I'm coming to you live from San Diego, and it's supposed to be unseasonably warm today. So in between my appearances on Fool24, the dog and I are going to take a much-deserved walk.
I'm still waiting for the warm weather myself.
I don't know what the weather's like in Tbilisi.
Lots of snow right now.
Not warm.
Nope. So today's show is earnings reactions because it has been a busy, busy week of earnings. I know there's been a lot of coverage of Nvidia. So if you're just tuning in for the first time and you're still looking for some questions on Nvidia, I'm sure of the two of us, Danny will definitely have some opinions. I am not the most qualified person to talk about Nvidia, but we are going to talk about we'll try to cover as many as we can. Obviously, some of our expertise can be a little bit limited. Danny, was there an earnings report other than Nvidia or that stuck out to you? And if not, what stuck out to you about Nvidia?
Uh, I'll be honest. The bulk of my attention has been on Nvidia since late yesterday. So I will probably lead with that. I am going to try to pull up some slides that I created, and hopefully those will come up here. There's a little process. It's a little different than just looking at a web page. So I actually have to pull the slides in. So that is happening right now. In the meantime, I think the market's general reaction to Nvidia's results was a collective yawn. The company exceeded its own guidance for the quarter. It exceeded Wall Street's expectations by about $1 billion. And despite the fact that it really was a solid report, there was a lot of ho-hum. Yeah, this is what Nvidia always does. And so after being up, this morning, I think what we're dealing with right now is, less enthusiasm, let's say, than we might have seen in previous in previous reports. I've got those slides up now, and looks like we have the correct ones. I'm happy to see that. So for Nvidia's fiscal 2025 fourth quarter, which ended January the 26th, the company delivered revenue of $39 billion. That was up about 78% year over year. The number that I look to focus on here is the fact that it was up 12% sequentially. And that's something that's been happening quarter after quarter going back about 2 years, which meaning there's an acceleration happening. So not only is Nvidia generating year over year growth, but quarter over quarter growth. So each successive quarter, the numbers continue to go up. Now, I will say that that cannot continue indefinitely. Eventually, they're going to hit the law of large numbers, and that's not going to keep up. But for now, Nvidia continues to do that. And I've got the numbers here. It shows consensus estimates were 38.16 billion. Nvidia's forecast was 37.5. So Nvidia, delivered $1.5 billion more than it thought and $1 billion more than what analysts thought. That resulted in adjusted earnings per share of 89 cents, up 71%, which is pretty impressive. Now, if there was one thing that Nvidia investors may have had a little bit of a concern about, it was the margins. Nvidia, their margin for the quarter came in at about 73 on a GAAP basis for the gross margin, and about 73.5 on an adjusted basis. That has been shrinking the past couple of quarters. Nvidia has said that that is a result of ramping up production of its latest AI chip, the Blackwell processor, and it expects that, after a couple of quarters, it will revert to its usual higher number. And finally, that Nvidia beat analyst consensus estimates of about 89 cents. Now I'm going to go to the next slide here, and it looks like that worked. So the results were driven primarily by data center revenue. Now, Nvidia's data center segment contains processors that are used for in data centers to move information around the ether, chips that are used for artificial intelligence, chips that are used in cloud computing. And that segment had record revenue of 35.6 billion, up 93%, still remarkably close to the triple-digit results that it gave us for the past 2 years. Gaming revenue was actually down. Now, there's 2 reasons for that. First of all, gaming is historically been cyclical. So it's down 11% year over year and 22% sequentially. Nvidia management mentioned that there were supply constraints. There was so much demand for the AI processors that gaming chips took a little bit of a back seat in terms of production. And so that's the reason why gaming chips sales were down a little bit. Professional visualization was up 10% year over year. I was really impressed by the automotive and robotics segment. Now, Nvidia has added the robotics to the automotive segment in recent quarters, and that's up 103% year over year and 27% sequentially. Comments made by management on the earnings call were that they expect outsized growth from this segment going forward because there are a lot of AI chips that are used in robotics as well as in the cloud and in data centers. And finally, for the fourth quarter, for the fiscal 2026 first quarter, which started January the 27th and will end in late April, Nvidia is forecasting revenue of 43 billion, which would represent growth of about 65%. Now, these numbers that I'm about to tell you was before Nvidia reported yesterday. Analysts were expecting revenue of 42.1 billion, or growth of about 62%, and adjusted earnings per share of 93 cents, or growth of 52%. What's interesting is I plugged all the numbers into this spreadsheet yesterday, and since Nvidia reported, I've been amused by the fact that analysts are ratcheting up their revenue expectations for the first quarter, and those numbers are now above 43 billion for the consensus expectations, because they are deferring to Nvidia's management on what they believe will be happening in the first quarter. So that is my take on Nvidia's um, earnings.
Danny, before you pull that down, I'm just going to ask one quick question of clarification for everybody. That growth number that you're reporting, is that year-over-year growth or is that sequential growth?
That is year-over-year growth for
Thank you.
everything on the last slide. And let's see, I'm going to pull this down. And that worked yesterday, 'cause I had an epic fail with the slides yesterday.
Well,
First time doing that, but it worked well.
I confess that I was slightly less prepared than Danny was. I don't have any slides for the earnings reaction that I had because mine wasn't Nvidia. In my weird esoteric world, instead of looking at trillion-dollar semiconductor companies, I decided to go with a $2 billion home builder because, hey, you know what? Home building really matters in the United States, and I think it's one of the more attractive industries today, despite some of the headwinds that we have been talking about for a long time. The company that reported actually this morning, and I'm sorry, they reported last night after the close. This was Green Brick Partners. They are a kind of a boutique, smaller home builder, mostly focused in the southeast area of the United States. One of I think one of my favorite companies in this industry from an analysis perspective. I think they're the best underwriters in the business, bar none. And I think their financials showed that Q4 revenue was up 24%. Earnings was up 46% year over year. Its debt to capital ratios declined. Its return ratios, its rates of return increased. It pretty much across the board, everything looked quite stellar. They increased their total controlled lots and land for development for 2025 and into 2026, and even included a $100 million buyback, which, it doesn't sound like much, but when you're a $2.7 billion company, that matters a little bit more than if you're a $1 trillion company. So all in all, I think it was a pretty impressive report, especially considering that we've kind of had some up and down reports from a lot of other home builders these days. Gross margins taking it a little bit on the chin because they're trying to incentivize sales by doing a thing called buying points on your mortgage. Basically, they will, buy a couple of your interest rate points on your mortgage at the upfront cost to, so instead of when you go to get your new mortgage for a home and it's like 6.57%, it'll be in the 5.5%. It's a way to kind of incent people to make a sale and things like that. Seen a lot of that across the industry. A lot of companies, reporting either flat or weaker margins. Also, backlogs are looking a little bit strained depending on who you ask. But I think of all the reports I've seen in the home builder industry so far, I've been most impressed with Green Bricks on from a margin and growth perspective. Their backlog also, it took a little bit of a hit, but that was actually on a average selling price basis. So they started building a little bit lower entry, a little bit lower price point homes, perhaps maybe trying to incent a little bit of demand here, which is, I think, favorable, especially at a time when affordability is becoming a larger challenge. And also, perhaps if Lower price points tend to be a little bit less customization, a little bit more cookie cutter in your designs and construction, which can cut labor costs at a time and also cut materials costs, which at a time where we're facing things like tariffs, labor constraints in the construction industry, this might be a tactic to help to preserve some margins. So all in all, I think this was a stellar quarter. I mean, the market likes it a lot. It was up as much as like 10% at the open today. And I think it's up by like 8.6% now. In terms of reactions for most home builders, I think this was a welcome sign in an industry that has been pretty cheap and not a whole lot of performance as of late. But I think this industry is going to do relatively well over the very long term. And this is a business trading for like 8 times earnings. I really like it.
8 times earnings. That's something that you don't see in tech.
And if you do, something went really wrong.
Really wrong, or it's really just incredibly rare. So we have a question here from Jimbo has a question 17 minutes ago. And this is regarding Axon, which is also ticker AXON. And the question is, what is the impact of the dropping of Flock? This is something that's come up quite a bit over the past few days. Axon basically dropped a bombshell a few days ago. One of the company's longtime partners, Flock, which is license plate reader technology, and that was integrated into Axon's offerings. There was a kind of a high profile split or divorce, if you will, between the companies. It was kind of unceremoniously done. There were comments from both companies' CEOs in the press that were derogatory towards the other company. And so there's been a lot of question about whether or not this would adversely impact Axon's results going forward. I think the best commentary from that comes from the company itself. Now, yesterday, after Axon reported its results, they had the earnings call with analysts. And there was a question from one of the analysts, and basically said, so, can you give us more insight into the split from Flock Safety, and wanted to know, how is that going to impact their technology licensing now that the partnership is over? The question was answered by Joshua Eisner, Axon's chief revenue officer. And he said, we did exit a partnership with Flock. He said, however, I think both sides have an interest in getting back to that partnership. We have proposed new terms. I think what we're asking for is just a more fair flow of information into Fusus, which is their cloud information gathering system, just like we support into Flock's operating system. And he said, and to Flock's credit, they have been receptive to our feedback, and we hope to be able to resume the partnership. So as much as it was highly publicized that the companies had split, I think what we're hearing now is that may have been a tactic, a strategy for leveraging their position and saying, hey, look, we want information flow going both ways, not just one way. And I think this is not the end of the story. There's the potential that they're going to get back. They didn't say it was going to have any immediate impact on them. And I think what you will see, and what I have seen in commentary from some law enforcement agencies, is that it's unlikely that Axon would take a hit. They would probably just adjust their prices to the law enforcement agencies if there were any additional expenses. So I don't think this is over yet, and I think it's probably in the best interest of both companies to come back to the table, and that's what I expect will happen here in the near to distant future. Tyler?
So going from tasers and body cameras to grocery stores, because that's how we do things around here. There, it's earnings reactions about everything. Let
That's
It
how we
Ride
roll.
asked, yeah, Let It Ride asked about 18 minutes ago to me personally. Tyler, TBBB, which is the ticker for BBB Foods, is not doing well of late. Is this just normal up and down stuff, or something negative happened? Um, as far as I can tell, for those who aren't familiar, BBB Foods is a Mexican hard discount grocery retailer, relatively new entrant, just IPO'd last year. One of the stocks I follow quite intimately. As far as to the question, I think it's just pretty much up and down stuff. I did just a quick news search. Disclosure search, looking through see if there was an 8K or anything like that that has been filed as of recent, and it doesn't appear to be the case. It looks like the only thing that I see, it was like about a month ago that said that they had done a secondary offering of its stock, which was, they basically said is to fuel its growth. This is a business that's very much in growth mode. They have about 2,600 stores as of its third quarter report. Its fourth one is expected to come out relatively soon. So when we get the full numbers there, we'll know. But the plan is to get to 20,000. So we're at a pretty large trajectory for growth in this business. And so it's still cash at this point is king for them, and we'll need some to kind of fuel and accelerate that development. And I think that's why they went to the market at this time. Other side from that secondary offering that was at the beginning of this month, there hasn't been a single press release or financial filing. The only follow up to that particular one was that the underwriters actually picked up their option, which might be a good thing because they saw something in it that they wanted to pick up the option to for the additional shares. So all in all, I would say, yeah, pretty. No news really, just kind of the vacillations of the market. I think this is just kind of how it will be for, especially for a company that doesn't have a lot of news. Like stocks just gonna kind of trade up and down 3, 4, maybe even 5% on any given day. And then this is actually a follow up for this is a great question for both of us because it's it's not company specific. We can go in any direction we want. Following up on Let It Ride's question, it says, are there any earnings so far that have affected your investment thesis in companies you follow? Um, I'll go first, and then so it can give Danny a minute or two to think about his response. But the one that stood out to me the most, uh, in terms of excuse me, in terms of like maybe changing my thesis or altering it a little bit, was First Solar's, the solar panel manufacturer. They had from a financials number, it was fine, nothing spectacular. It was good. It was I'm not gonna praise it up and down for a quarterly earnings report that was more or less in line with what they said they're going to do, especially with a lot of stuff ramping up in terms of production and things like that. Here, the thing that surprised me the most was in this annual report, they started to give hints at their next generation of technology. First Solar for decades has used a thin film solar voltaic technology known as, and it's the conductive agent is known as cadmium telluride. When we compare it to typical silicone or based photovoltaic cells, it's actually ever so slightly less efficient, like when you test it in the lab, but it's proven to be more durable, tends to retain its efficiency for much longer out in the field. It can have a little dirt on it. It's not going to affect it too much. So it's a little bit more of a durable product, and it's why utility scale customers have liked it, and it's been such a popular thing for so long. The thing is like I mentioned, it's a little bit limited. They've been able to get its current offering, which is called the Series 6, up to about 18.7% efficiency, which it's fine. It's been it's been a popular product, and it's sold a lot. They have about 68 gigawatts of backlog, and this is a company that produced 14 this past year, so they have multiple years of backlog of sales. Um, this particular quarter, they started to talk about their technology ramp for the next generation of solar panels. And what they were looking at in particular was it's a new technology known as perovskites. This is it's a little bit more complicated than a typical metal, but it's called a metal halide. It's like a crystalline form, and basically what it can do is it can absorb more of the light spectrum and collect energy from it. It's considerably more efficient. According to the Department of Energy, the theoretical top end efficiency for a perovskite based thin film solar panel is up to 36%. So we're talking about a near doubling in terms of efficiency for solar panels. This is really one of the first time that we're looking at solar taking a stepwise function change in efficiency over the next couple of years. They're talking about this becoming part of their commercial roadmap. 10 years ago, this was just like a theoretical thing that, whoa, maybe if we could do this, this is really cool. But it looks like it's going to be a real thing, and it's going to be part of its commercial roadmap. It thinks that within a couple of years, this is going to completely replace its Series 6 and its you know, it also has a Series 7 that they're working on now, and they'll probably, what ends up happening is if they can develop this perovskite type of product, they will probably try to retire its Series 7 orders and see if they can upsell people on this combined thin film. Because why this matters, why efficiency matters, efficiency is a huge component of, number one, like how many panels you have to order to meet the total power demand. So if I can double my efficiency on utility scale solar, I can reduce my total footprint by half. I have to put half the panels in the ground to actually achieve those things. This would be monumental for the business and make it much, much more economical than it has been in years past. This could be, I don't want to call it a game changer, but this is a makes it competitive in a way that I don't think we had thought about solar previously, and makes me very excited about the long-term trajectory of this company. Um, you know, eh, uh, right now it's in terms of like immediate availability for, meeting energy demand for like AI, it's basically a two-horse race between natural gas and solar because they're the quickest to deploy. Um, Nuclear is 10 years out, small modular reactors are 10 to 15 years out, even coal plants take longer than deploying natural gas and solar. So I think there's a lot here on the bone, and this is a business I've owned for a very, very long time. I've picked at it at times because it's cyclical, but if this is going to work, and they're actually even willing to announce it in their commercial product roadmap, I'm gonna have to look at this thing again really hard.
So I would say, generally speaking, I haven't seen anything in the earning reports that I follow that would make me change my investing thesis or affect my investing thesis. Um, I think the one that came closest to meeting that description is Super Microcomputer. For those of you who have been following the ongoing soap opera that is Super Microcomputer, the company was hit by a short report. They then delayed issuing their financial reports, their annual report, and two subsequent quarterly reports. There was a report of a DOJ investigation potentially. There was essentially, it was just out of the frying pan into the fire. Then they announced that their auditor was leaving. As a CPA, I can tell you that auditors don't generally just leave, and certainly not in the middle of an audit. They have to be, there has to be some pretty serious disagreements with management on accounting issues for an auditor to do that. And Ernst & Young was their auditor. That's one of the biggest Big Four accounting firms, and one of the biggest in the world. They left. So it was kind of a big soap opera. They had until yesterday, I believe it was, or the day before, to get their financial reports in um, before they were delisted by the NASDAQ. So, this is one that I have been extremely hesitant about adding to. It's a stock that I own. And I think the biggest issue is the fact that when you don't have the confidence of your auditor, and when you're not able to get your financial returns in on a timely basis, that kind of calls management's abilities into question a little bit. Now, they did finally meet the deadline. They turned in their financial reports. So I would say that I am moderately more bullish on them than I was before this happened. I still have some questions. I still want to see, perhaps something from their new auditor that gives me a little bit more confidence. And I want to see them turn in their financial results more timely. That said, I think that they have the potential to earn back my confidence. And they've taken a step in the right direction, but they still have a little bit further to go in that regard. So, not really a big change in the investing thesis, more a subtle shift in sentiment towards the company. I'm going to pivot right back to Axon. A question from Foolist from a few minutes ago. Axon pulled back today after yesterday's rise. Is there more information available which may have caused this? Um, I want to start by saying we probably need to look at what's happening in the broader market right now. According to CNN Business and their fear and greed index, there's extreme fear that's driving the U.S. market right now, and you can see that in the fact that both the S&P is trading just below break even. The tech-heavy Nasdaq is down about almost 0.7%. So we're seeing kind of a broader pullback in the overall market today. And I don't think that Axon is going to be immune to that. Had a pretty good bump yesterday after investors had an opportunity to review the results and to hear what management had to say about the potential for resuming their relationship with Flock. So I don't think that there's necessarily any new information. I think investors have had time to digest the results. But also, I think, when you're seeing a broader downdraft in the market, particularly in tech stocks, there's very few stocks that are going to be able to resist the siren call of profit taking. And I think that's the other thing that could potentially be weighing on the shares today is the fact that it had a big bump yesterday, and after that uncertainty, some investors are going, I'm going to ring the cash register now. I'm going to take some profits and see what happens. So I don't think there's any, I don't think there's any more big news out. It is just the daily machinations of the market and not anything that I personally would be concerned about. Tyler?
So about an hour ago, Kim asked a question about Millrose Properties. Kim, I hope you're still with us to get your question answered. Kim asked, any thoughts on Millrose Inc. or Millrose Properties? I recently received some shares because of a merger with Lennar. Um, I should mention it was a spinoff of Lennar. Millrose Properties was a real estate development company that was spun out of Lennar, the home builder, because what basically Lennar was trying to do was to run what's called a land light development strategy, where another company, in this case Millrose, will do all of the development of the land to get it ready for a home builder. That means, they're going to do the sewer work, the electrical work, the zoning work, do some of the basic like earthworks to get the land nice and flat and easy to pour a slab concrete foundation or whatever the home builder decides they want to do. Get the utilities hooked up, make sure that, things like roads and emergency services, utility poles, fire hydrants, things like that. That's the duty of the land developer, in this case, Millrose. By taking this on, what will happen is that home builders will have what are called option contracts. They will sign a option contract with a land developer to pay a small portion of the lot purchase, which is called a lot option contract. Millrose takes that money, develops the land, and then delivers the product to the owner or to the home builder when it's ready for a home, and then the home builder pays the remaining on the lot option contract. It takes all of that development process off of the books for somebody like Lennar, because it's something that it's something that's been very popular in the home builder industry, because typically home building is a very, very capital intense business where there's really long lead times. If I'm trying to go from a fallow plot of land to 150 subdivided lots and then and fully built out, that can take 18 to 24 months to do, and that's just for the development itself, not talking about just the full build out of the entire community of the homes. So with that much lead time, it means lower returns on capital, because you have all this capital tied up in the land. Lennar wants to spin this off into an independent land developer to whom they will pay, these lot option contracts. The goal for Millrose ultimately is to become big enough that they can just be a lot option developer, not just for Lennar, but the rest of the entire industry. I'm pretty sure I did go through the agreement, and I don't think that Lennar has any sort of like exclusivity rights with Millrose or anything like that, aside from perhaps this existing inventory that they gave to Millrose to start the thing. It's a novel concept. It's not the only one. I know there's another publicly traded lot development company. I believe it's called Four Star Group. DR Horton owns a portion of it, but it's not like, it as an equity stake, but it wasn't like DR Horton's business that they just, kind of calved off into the market. So I don't, I think it's going to be an okay business. I don't know if it's going to be great. Some of their target returns on equity are pretty low. They're probably going to load up on debt to kind of grow not a lot of debt, but they'll use debt strategically to build a lot position in the coming years, because right now it's pretty much debt free. All in all, I think it'll be an okay business. I just, with returns that projection in the 8% return on equity range, I can't say I'm too excited about it. You would have to be very, very selective at the valuation at which you would buy it. However, if you were inherited these shares from your position in Lennar, that's a little bit of a different story, because basically I wouldn't say it's free, but you certainly didn't, make an active decision to make this purchase. It's something to watch. The dynamics are a little bit different, and I would say, I think the best advice is just kind of watch it for a couple quarters. I certainly will be following up on it, because it is a novel concept, and the home builder industry is full of copycats. I would not be shocked if some of the other ones like Pulte Group and KB Home and everybody else either sells their lots that they still have on their books to a Millrose type company, or decide to spin off their own. That there isn't a lot of innovation going on in this industry, and if somebody comes up with something novel, they all try to copy themselves.
So saw a question in the queue from Sadaf from about 20 some minutes ago. How does Taiwan Semiconductor Manufacturing, ticker TSM, decide who to serve first? And adds the tickers for Advanced Micro Devices, ticker AMD, and Nvidia, ticker NVDA. That's a really interesting question. I don't know the answer categorically, but I can perhaps give you a little insight. So I looked into the company's earnings call transcript, and it kind of hints at it. It says to address the structural increase in long-term demand profile. Um, Taiwan Semiconductor Manufacturing is working closely with our customers to plan our capacity. That was from Chief Executive Officer CCY. Now, maybe to give this a little bit more color, Taiwan Semiconductor Manufacturing is the largest provider of advanced chips in the semiconductor industry. Um, they not only serve AI, but they're also one of the largest suppliers of smartphone chips. And it is widely believed that Apple is, if not its largest customer, one of its largest customers in recent years. And Nvidia is certainly moving up the ranks to being one of its biggest customers. But I think this is probably a function of demand, but it's also a function of, these companies all have existing contractual agreements in place, which may change from time to time. When you have these contracts with the company and say, you will supply us with a certain number of chips within a certain amount of time. And I imagine that's part of the reason why Taiwan Semiconductor is expanding its operations, and it's building out its chip production capabilities by bringing new facilities online. So I think it's a combination of factors. I don't think we know exactly what the answer is. Um, but I think a lot of it has to do with contractual obligations. I would also think that if one of your biggest customers who pays the bulk of your bills comes to you and says, we need a little bit more capacity, they may very well provide that capacity by bringing on additional shifts or paying more workers to come in and stay instead of just working one 8-hour shift. Maybe they have another 8-hour shift come in. So really a combination of things. I don't think we would ever know that exactly unless, we were among Taiwan Semiconductor Manufacturing's management team. But I think those are the factors that, would go into that process. Tyler?
I have nothing to add.
Fair
You
enough.
know, I've had one uh, listener or viewer, whatever we're calling Fool24 viewership. We've had a couple questions, specifically from I Need Input. There's some older questions here about Kelly Partners Group. And I saw that also there's a couple other questions in here specifically related to Kelly Partners Group. I'm trying to dig them all up, but it may take me a moment or so. Basically, it was just kind of what are my thoughts on this one. There have been some discussions of this with recommended recommendations in various Motley Fool services and some presentations related to this company. And so people asked for my thoughts, and so I thought I would give them. Um, Here is what I have seen so far, and perhaps I'm missing a few things, and I apologize if I do get a couple things wrong. But this is an Australian company. It has an over-the-counter ticker in the United States, so trades on what's called the other term is considered the pink sheets. This is it's an accounting firm, basically not too, I wouldn't call it like one of the big four accounting firms. This is going to be probably a little bit more on the small to medium business sort of realm. And one of the things that they have done over the years is kind of be a little bit of a industry consolidator in the accounting space. This is, accounting like, Danny's work as a CPA or, getting your typical tax professional, you can either businesses can outsource some of its accounting functions, or if, for tax preparation purposes and things like that, you can have a private company do your taxes for you. Um, there is part of it that I am uncertain about. I don't know a whole lot about Australian tax law and the demand for accounting services in Australia, so I have to feign a little bit of ignorance in this regard. But what it appears to me is that this is a business that has grown all in large part thanks to acquisitions. This has been a business that has uh, it's doubled it, as manager said. It kind of was founded in about 2007, and it was generating about $1.2 million worth of revenue then. Today it's generating about 134 over the past 12 months, according to its recurring run rate. So I'm guessing that the way that they uh, book their revenue is sort of like a services rendered remaining performance obligation, not too dissimilar to software companies or electric, contractors, construction contractors. But that's like 30-year revenue growth, annualized revenue growth. It's pretty impressive. Some of it, like I said, has been in acquisitions. They make a lot of bolt-on acquisitions, and there's been a lot of growth involved. The one thing that I'm struggling to understand, because I feel like I'm getting some conflicting answers depending on my data provider that I use. But the thing that I did notice is this: even though we've seen, net profits increase at a very respectable rate, the per share profits have been a little bit more wanting. And by the looks of it, I'm looking at a data provider that I use quite frequently called Koifin. It says that about 10 years ago, they had about 31 million shares outstanding, to today 45. So we've had an almost 50% increase in shares outstanding, which, when you growing revenue is great, or I'm sorry, grow your bottom line at a high rate is good. But if you're diluting it along the ways, it's going to, you have to grow that much faster to induce per share growth. That's the one thing that seems to stand out to me in its financials. Aside from that, it looks, just from a financials business, I think accounting is still a business that's going to be around for a long time. I don't know how much AI has been penetrating the accounting business. Danny might have some insights into that ever so slightly. But at first blush, I would say this is an okay business, and I would like to. It's priced pretty high. I think it says 134 times earnings, and I think I calculated out at about 56 times free cash flow. So you're certainly paying a considerable premium for this business. Granted, it is growing, and it's hard to get an accurate read on earnings per share when you only have a penny of it, and that's going to make your earnings per share, your PE number, look pretty high almost regardless. So there's a little bit more digging I would like to do before I say yeah, this is a great stock or not. But there's some things to like, and there's a couple things that for me are signs of, let's be a little cautious here before we run to the door and hit the buy button.
Yeah, and just anecdotally, I have heard from some colleagues in the accounting space that there is a little bit of disruption happening in the accounting field with regard to AI. Some of the early adopters of AI in the accounting field are using the technology to automate, some of the more routine tasks. Some of the things that a company called Blackline, ticker BL, has been doing, which is to, automate some of the data entry, some of the reconciliations, some of the basic reporting tasks. But that is also allowing accountants to focus on the higher level, more strategic, more complex, and coincidentally higher paying tasks. So there's a little give and take, but I don't think we're seeing any major disruption at this point. Having said that, I want to hit two questions back to back. The first is from Ajit Jain about 11 minutes ago. I need some short-term thoughts on Tesla. Do you think it will continue its downfall and go to 200? I want to tell you that if you're looking for short term thoughts. You're probably not going to get too many of them here among Motley Fool analysts and contributors. I will say that there are a couple of things going on with Tesla right now that investors should keep in mind. The first of which is that Tesla saw a decline in its sales in Europe. Now, there is some question about whether or not that declining demand is a result of market saturation, or whether it's likely has to do with Elon Musk's foray into the political realm. That I have read online, there have been some folks that are uh, establishing a boycott against Tesla because of some of the things that Elon Musk is doing. This is not commentary on whether or not those things are right or wrong, but merely just some of the things that I have read. So I think when you take those issues and the fact that some investors are not happy that Elon Musk is spending so much time and energy and devoting it to politics rather than devoting it to running Tesla, which I, as a shareholder, have some of those concerns. I think that the stock could continue to fall. Over the long term, I think it's too early to tell. So, not anything that I would, I'm not changing my investing thesis on this just yet, but I am concerned about, some of the developments, considering that much of Tesla's success is down to Elon Musk's focus. And as he spreads that focus, I think there's the potential for the company to be less successful. Just my 2 cents. Um, and also from Ajit a few minutes ago, David mentioned after the trade desk earnings, and I'm not sure which David he's referring to, that it might go down more into the 70s and would be a better buying opportunity. Is it a buy now, or is it going down more? Um, I don't think any of us can answer that, at least not with any degree of certainty. Um, if somebody says they know what's going to happen with the stock in the future, they're either guessing or they're lying. That's just the nature of the business. Now, I would say this: I am a long-term holder of the trade desk stock. I believe they have a long track record of growth. Their CEO, Jeff Green, is a pioneer in the programmatic advertising industry. In fact, he developed the first platform, the ad buying and bidding and selling platform, that exchange was eventually bought out by Microsoft before he founded the trade desk. So I think we need to take all of those things into account and not let a one quarter stumble be the defining moment for a company that has been delivering for years. So, yeah, I don't know whether or not the trade desk stock is going down into the 70s or not, or below 70. I think it's about $73 dollars a share right now. Over the long term, what I think is 3 to 5 years from now, I believe the trade desk stock will be much higher than it is now. And that's just my belief. And, based on the evidence that I've seen, I'm certainly not selling my shares. And I will turn it back over to Tyler.
I don't normally comment on these companies too much, mostly because I'm a little less familiar with Trade Desk, and there's so many opinions on Tesla. I don't, I don't know if mine really counts for much. The two things I will say though on the valuation of Tesla is valued, I would say not on its current automotive industry position. It's valued much more heavily towards the robotaxi, humanoid robot, the 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 long the moonshot bets that the company has been saying that they are going to do, and valued in a way that it would seem to me that it's presuming successful deployment of these technologies within the next couple of years. Whether that happens or not, I'm not sure. But if you're, automotive sales, yes, it's going to be a cash engine, hopefully, to spend, pay for these efforts. But if you're seeing precipitous declines in sales for any various reason, that could dry up the cash and make it harder to deploy these newer ideas. And so just something to stew on as you think about the valuation of Tesla. And I can't say anything about Trade Desk directly, but I will say that advertising writ large is seeing a little bit of a lower rate. Advertising agency WPP recently reported that they are seeing weaker client discretionary spend. WPP is a company that helps them make advertisements, not necessarily like trading and things in them. And so if companies that are, employing WPP for advertising, and they're pulling back on discretionary spend, I think that's something that you could see across the board of any advertiser, whether it be Meta, whether it be Trade Desk, whether it be Alphabet. Anybody who generates significant revenue from advertising could see a writ large sort of decline in spending, and pricing for ads could get a little bit more competitive, I guess, if you will, if the reports from WPP are to be believed.
Well, that's actually a marvelous color there. Thank you.
It seems like there's a lot of questions that are way, way more in your wheelhouse than I can say anything of mine. Um, Danny, are you seeing anything else? We've got about 3 minutes left.
Matt just asked Danny, have you ever personally met Jeff Green or David Pickles? Uh, to my detriment, I have not. I have actually seen a number of interviews, both in person and on video, where Jeff Green was interviewed by either Tom or David Gardner, which has happened numerous times over the year, and also by former Motley Fool interviewer extraordinaire Chris Hill. So I have followed them greatly. I think both are industry visionaries. Jeff Green, well, Dave Pickles more in the technical side, and Jeff Green certainly in the advertising side. I have not met them, but I would love to.
So I'm gonna go back into the Wayback Machine for one last question, and since I think it will uh, pretty much cover our time here. Investment Vertigo asked one day ago, gentlemen, please comment on Honeywell stock, which is ticker HON, and what. And maybe tell me what they look very enticing and even involved in quantum software. Is it an opportunity? Thanks. I think the most important question that you have to ask with Honeywell is the fact that it is planning to split up into three separate businesses. This was announced back on February 6th. Basically, an activist investor, Elliott Management, took a large stake in the company and was kind of instigating for change with board members and things like that. And part of their plan was to actually split the company up. It is a conglomerate, covering quantum computing. It has a significant business in the aerospace industry. It does a lot of HVAC work. Kind of one of the old-fashioned industrial conglomerates that has its fingers in many pies. And there aren't a lot of them anymore because most of them have gone through this breakup process. We just saw General Electric go through the big one where they're GE Healthcare, GE Vernova, and GE Aviation now. Which so far, I mean, I'm only basing this on stock price, but I think it has looked lucrative for those investors in the short term. And something I did notice, at least from the GE Vernova, which is its power business, that did look quite promising. I think they, being able to focus on just the power generating assets was a pretty good move for them. So instead of trying to make a definitive decision on like what Honeywell looks like right now, I think what's going to happen is anybody who's looking at Honeywell just wait, see what this breakup plan looks like and how these businesses are going to be structured post breakup. Not just like what the businesses they have, but what kind of debt they're going to carry, what kind of investment plans. Are they going to be like big dividend payers, or they have a lot of growth investment opportunities? I'm going to guess the division that has the quantum computing division is probably going to be one that retains a lot of cash flow and invests in that. Whereas, it's HVAC, like they were I feel like every house from 1974 to 85 had that single Honeywell dial thermostat in everybody's home. So
I know I
I,
did.
I yeah, they might still be out there. I kind of wish I had one in whatever home I live in the future. Probably a business like that is definitely going to be like a more of a steady Eddie dividend payer. So I think all of those, if you're considering Honeywell, not going to hurt to wait a couple months and see what happens when we do this big shakeup. And with that answer, that brings us to the top of the hour. And we will be going from earnings reaction to the retirement show with Dan Kaplinger and Robert Brokamp. And for that, we will be saying thank you and Fool on. Enjoy, guys.
Hold on,
Thank you,
guys.
Tyler. Thank you, Danny. Welcome, everyone, to really anything related to financial planning that you want to talk about. Could be retirement, could be saving for college, could be insurance, asset allocation. Oh, I don't know, taxes, estate planning. It is tax season after all. Dan and I will be very happy to answer your questions. But we're both former financial planners. I still have the certified financial planner designation. Dan is also a former attorney. So get those questions into Slido. If you don't see Slido, maybe scroll down on your screen, depending on how your screen layout is. You might have to scroll down to see it, or just go to slido.com and enter the code Fool24. We will answer your questions. As questions come in, talk about a few things on our minds. I'll just highlight that we are now almost at the end of February, so we are already about 1/6 through 2025. And at the end of the month, I always take a look back and see how things are going. I'm just going to provide a few observations. It's been a slow-ish year for most U.S. stocks. The S&P 500 is up about 1.5%. Really, that's not bad for 2 months' work. Certainly slow, less than what we've experienced in the previous 2 years, but not too bad. But in previous shows, as I pointed out, international stocks are doing quite better. As of last night's close, they're up about 7% so far this year, although they're down today because of concerns about tariffs. President Trump has said the tariffs will go ahead with for Mexico and Canada, but then also Europe as well. So they're down a bit. But perhaps what might be most interesting is that so far, the U.S. bond market is outperforming the U.S. stock market. The Vanguard Total Bond Market ETF is up about 2.5% this year, which is nice to see because bonds really have been on a pretty lousy run for really about 5 years. In some ways, the worst stretch for U.S. bonds ever. And why are bonds up? Well, because interest rates are down, and particularly interest rates for treasuries that mature in 3 to 6 months or longer. Short-term treasuries are kind of holding their ground, but treasuries like the 10-year treasury, 30-year treasury, they have come down, particularly over the last 2 weeks. So you've seen a nice jump in bond prices. And in fact, the yield on the 10-year treasury is about the same, if not a little bit lower than the 3-month treasury. And what that means is the yield curve has inverted again. So this has traditionally been a very good predictor of a recession at some point. Doesn't mean a recession is right around the corner. Sometimes it takes anywhere from 6, 12, even 18 months. And sometimes it gives a false reading, such as the last time it inverted, which is in, I think, around 2022. So we didn't technically have a recession, but we definitely had a slowdown in the economy. So that's the thing that is attracting my most attention for me the most. Whether or not, we get an official designation as a recession at some point from the NBER, which is the group that gives us such things. I think it's an indication that the economy could be slowing down. We already see that in other ways. For example, layoffs, not just the government, but in some corporations as well. So that's just an observation, something I think to factor into your own decisions about your financial planning as well as your portfolio. But with that, I will turn it over to Dan. Dan, what's on your mind these days?
I'll just build on that just a little bit because it's been troubling me too. Whenever you get news of layoffs, both in the private sector and in the public sector, you start thinking about what the second order domino effects are going to be on the economy. Especially, I was reading an article in the San Francisco Chronicle about layoffs in the San Francisco area, as so many of those jobs are, if they're not being eliminated, they're being moved. Texas has been a high-profile destination for companies seeking to leave California, but it's not the only one. You're seeing a ton of interest in the southeastern United States as well. And so, questions come up about, is the pay the same? If the pay is not the same, is this cost of living different? All these things, it's something that plays into, then you start following the ripples out. And so you look at housing market issues, you look at, strong US dollar, the impact that has on foreign interest in purchasing real estate in the US. Still have a pretty tight housing market in terms of not many people are clinging to those low interest mortgages that they were able to get before interest rates went up. And so until they are forced to move, a lot of people are hesitant to do so, because getting a new mortgage these days, 6%, 7%, is not like the 3%, 4% mortgages that they had in the past. And so, the other thing just to pay attention to is, the trends in technology towards making companies more efficient. That is great for us as shareholders, as investors, not necessarily as good for the employee base. And then the question becomes, okay, if all of those former employed people are out of work, where are they going to get money to spend on the things that drive the economy? And if they no longer have money to spend on the things that drive the economy, then you start to get into what Bro was just saying about, maybe you do start to get some recessionary concerns. But it's one of those things that, you have to assess the impact in your area. Many of the federal government cuts that have made headlines lately, a lot of people focus on Washington, but I'll tell you, there's a lot of small towns where the federal government is a major contributor to the economy. There are large parts of the country where the federal government has a lot to do with the economic sustainability of things. And so, it's an experiment. I guess we're just going to see what happens as far as, when there are cuts, what are those people going to end up doing? What impact is that going to have? If the government is successful in finding ways to kind of reposition those folks, then it'll be a win. If those folks end up struggling and not being successful in finding alternative work, then maybe not so much. But we will see what happens from that. I wanted to touch on something. I was talking to my buddy Sina Hasuna. You guys know him as Sina NYC. Often will ask questions here on Fool24. And let me pause for a minute and just urge all of you, please do ask us some questions here on Fool24. Really just about anything. I mean, we've got individual stock questions that we prefer not to handle, because we are not individual stock analysts for the most part. But just about anything else with your financial planning, with your estate planning, with your tax planning. Can't give you individualized formal advice. Nothing that we give you should be taken as personal financial advice, but it is something that can point you in the right direction, kind of give you a gut check. Maybe you hear something in the thoughts that we talk about that raises your eyebrow and say, oh yeah, I didn't think about that. That may be something that you can then take to an attorney or an accountant or a financial advisor, whoever you have on your team helping you in your individual situation. So do please get those questions in. But with Sina, I was talking recently. Sina just recently did a consultation with a certified financial planner, and he was nice enough to share the experience, kind of talked through things. And one comment that he made was that he was kind of surprised when he got the deliverable, when he got the report back from the CFP. It wasn't really as detailed as I think that he was expecting it to be. Kind of more emphasizing on a big picture scale, less so on very specific guidance for, sell this, exchange this, maybe take care of this. There was some of that, but I'll tell you, getting a financial planner, finding the right financial planner for you, there is an element of, you need to find a relationship. You need to find something that will work for you. And different CFPs, they all have fiduciary duties to you, but the way that they execute those fiduciary duties can be different. Some CFPs, some financial planners will be highly quantitative. They will be happy to run everything through mathematical models. The firm that you might work through might have Monte Carlo simulations to kind of go through a whole mess of different possible future scenarios to try to stress test whether your financial plan will actually work in the worst case scenarios and the best case scenarios, kind of giving you a sense of how much leeway you have, how much flexibility you will have in any given plan. Some financial planners really love that. Other financial planners are less into the quantitative side and are more about relationships. They're more about making sure that people are comfortable with the general idea of investing, less so on, individual stock A versus individual stock B. And that can be something that really appeals to people who are intimidated by stock investing, who are intimidated by trying to do financial planning for themselves. The last thing that someone who doesn't know very much about financial planning, who's very reluctant even to get into it, the last thing that person needs to see is a detailed spreadsheet, because that assumes knowledge that is not in fact there yet. And so that person might prefer to have a certified financial planner who doesn't give as many details, but who can provide the confidence and assurance that there is a path forward and that the person will be able to help their client get through that. And so there is no, what's right for you might not be right for somebody else, but there's no wrong answer in general. There are plenty of people out there, but one thing that you can do so that you're not surprised is ask, when you have that first consultation, before you start getting in the nitty-gritty about what your financial assets are, what your job is, how much your job pays, what your family situation is, what your expenses look like, what your financial goals, what your financial plans are. Before you get into any of that, a perfectly reasonable ask to make is to ask that financial planner, can you give me a sample of a report that you did for another client? Or maybe, they're not going to give you information on the other client. They're going to black out the names, or they're going to take out the names or redact it, whatever they need to do. But to get a sense of what you're going to see at the end of the day, most financial planners, they come up with a strategy for how they make presentations to their clients. And for the most part, they follow them. Now, if you feel very strongly that you want something in particular in a presentation, most financial planners will be flexible enough to give it to you. But in the absence of specific direction, most financial planners have a comfort zone where they've worked with all kinds of clients and they know what works. And so they work the stuff that works into the report that they give. When you see that report, that sample report, that's your opportunity to say, oh yeah, this looks exactly like what I need. I'm looking forward to this. Or, you know what, this looks pretty good, except I'm going to need some more information about this. And then when you have that consultation with a financial planner, you can point that out. You can say, hey, can you give me more detail on this? Because I'll tell you, if I got this sample report, I wouldn't really know what to do. I wouldn't have enough information to go on. And so that is something to consider. And then finally, if the report just looks like total gibberish to you, you don't understand it, maybe it's got a whole bunch of spreadsheets in it and you're not really ready for the spreadsheet for you, or you've done your own spreadsheet and you just don't really agree with the format that they're going for, then go find yourself another candidate. And that's a good way to weed out what could potentially be a disappointing relationship, because nobody likes to spend money on a financial consultation and then not get what they paid for, not get what they expect. So I'll leave it at that. Please do share your experiences with financial planning, with guidance that you've gotten. And the same can be true for, attorneys or accountants, things like that. Just about anything that you're talking through, just kind of getting a sense of where those mismatched expectations can be and maybe what you've done to match them up so that you can strengthen that professional relationship. Or if you just decide to go your separate ways, that is always an option as well. All right, that's all I've got, bro. I'm going to look over questions and see if we got any questions coming in.
I'll go ahead and answer one and really sort of two of the questions, but feel free to get more questions in, folks. And this question comes from Let It Ride. There are a lot of choices for retirement calculators out there. Which one do you like? And I will try to get the link into Slido at some point, but it's from Calc XML. Calcom Excel has several retirement calculators, at least a few. So you're looking for the one that has 606 at the end of it. And you're right that there are a lot out there. And there actually been some studies that showed that a lot of them are actually pretty bad. So if I may, I'm going to try to share my screen and just go through the calculator very quickly to demonstrate what I like about it. But just so you know what I think is a good thing to have in a retirement calculator, so that when you look at other ones out there, you know what to look for. So here it is. It's not very fancy looking, very simple. You got the URL up the top. One thing I like about it is that it breaks up the spending in retirement into 3 stages: early, middle, remainder, or what some people call the go-go years, the slow-go years, and the no-go years, because research indicates that actually retirement spending does not go up every year along with inflation. It's a little bit behind inflation, 1% to 2%, and sometimes even goes down, right? Especially if you're entering like a retirement as a married couple and then one passes away, or you enter retirement with a mortgage and the mortgage gets paid off. So that's one thing I like about this. The other thing I like about this is that you list all your different assets, but then you can choose whether it's traditional Roth or taxable brokerage account, because not every retirement calculator will distinguish between the tax status of your accounts, which is a pretty big deal. Whether the money coming out of your account is being taxed as ordinary income, like a traditional account, tax-free is in a Roth, or a mix of income, I would say interest, dividends, capital gains, and a taxable account. So that's another reason why I like it. There's lots of other details here that I won't go into. You can choose to include Social Security or not, and the tool will calculate Social Security for you based on what you enter at the top as your salary. But that's probably just an estimate. You should use your own actual projected benefit, which you can get by creating your My Social Security account at the Social Security website. But then you can choose to ignore Social Security if you want, or give yourself a haircut. We talked yesterday on the retirement show, or on the financial planning Power Hour, about how it might make sense to assume you're only going to get 75% of what you're projected, because the trust fund will be depleted in 2033. And then the other thing I like about it is here you can add other things, right? It could be maybe you're going to sell a business, you're going to sell your house, maybe you have a vacation home that you plan to sell, or an RV. There are other ways to enter other sources in here. Maybe you expect an inheritance. Of course, you don't know when you're going to get that inheritance, but you could factor that in. And then down here, it provides where you enter in the returns, and not every calculator will allow you to do that. Some calculators put in the return. This way, you can determine your own returns. They're pretty conservative, and even has a little pop-up there that shows you what historical returns, at least since 2023. And then also tax brackets are up here. But again, these are 2024 tax brackets. So I think that's all very handy. So those are the things I would consider if you're looking for a tool. And I'm going to stop sharing now. And then there was another question about whether there's something that will, if I want to get the words correctly here. Let's see, it was about retirement income. Where did that one go? Did it go away?
It might have gone away because it looked a lot like the one question that you did end up answering.
Got it. So okay, this one was specifically, this one was specifically about retirement income. And there are some calculators, Vanguard, for example, that will help you go through your projected expenses and sort of calculate them. I'll see if I can find that link as well. But that's something else to consider.
All right. I'm up. I'm not muted. That's good. 9 minutes ago, Let It Ride asked. No, this one was 11 minutes ago. Good morning. Do you think that it is better to buy or to rent? So I'm going to assume probably you mean a home, although it's interesting. Advice that I recently gave my daughter was basically if you have to buy something, if you can't pay for something all up front, then don't buy it. Now, that's not going to apply for things like housing, but it does apply to some extent for issues like clothing, like, for necessities, for food, for going out for a restaurant, for even like a car, although she's not in a position where she's had to purchase her own car as of yet. But the philosophy is pretty simple. If you can't afford to buy something, then the question becomes, are you overextending by coming up with another way of doing it? Now, this doesn't necessarily apply as much to the housing question because housing's a little bit different. And the reason housing is a little bit different is that having a home has both financial and non-financial consequences, both economically and things that you have to deal with. For instance, say that someone was going to move to a new city and they knew that they were going to be there for 6 months exactly, and that job was going to end, or whatever their motivation for going there was going to end in 6 months, and they would return back to their home. And the question would be, well, do you buy a house there or do you rent a house there? A lot of people, I think, would choose to rent because there's some time and hassle commitments that you have to deal with when you buy a home. You have to go shop for a home. You have to haggle on the price. You have to have the home inspected. You have to make sure that it is going to meet your needs, that there aren't any nasty surprises lurking in the attic somewhere. You have to get mortgage financing. You have to find a lender that's willing to loan you the amount that you're going to get. You have to pay closing costs. Then you're there, 6 months pass, you decide you're going to go back because the reason that you were there ended. So then if you bought a home, you'd have the same process to go through. You have to find yourself a real estate agent to sell your home. You have to deal with the buyer wanting to do all that whole process of getting the home inspected and haggling through with the price and trying to figure out financing. Maybe you get an offer, but the offer falls through because they can't get the mortgage that they'd expected to get. It can be a long and devastating process. And so a lot of people for 6 months would say, you know what, I'm not going to deal with that. I'm just going to rent a place. Yeah, sure. Maybe it's not going to be the place of my dreams, but it's only for 6 months. When you extend the time horizon, I think things get a little bit more complicated, but then you have to start to focus more. There is more of an economic element to it. As far as pros of owning a home, when you purchase a home, you enjoy, if you are in a market where real estate prices will generally trend up, then you will enjoy the benefit of that appreciation. And that's one reason why my example kind of works the way that it does. In 6 months' time, it's very unlikely that your home's value is going to appreciate very much. And in fact, you'd be lucky if it appreciated enough that you'd be able to cover 2 sets of closing costs essentially, and cover those, and still make a profit on it. Over a longer period of time, though, 5 years, 10 years, 20 years, you can often see a big increase in the value of a home. And when you're renting, you're not the one who gets that. Instead, generally, you're the one making monthly payments, and oftentimes those monthly payments will be going up over time. And so from year in, year out, you may pay a little bit more for your rent. And at the end of the day, you're not the one, if there's an increase in the value of the property, you're not the one who benefits from it. Whoever your landlord is going to benefit from that. The upsides of renting, on the other hand, are generally, they're the hassle factor and the economic factor of having to deal with maintenance, having to deal with unexpected repair issues, things like that. When you rent a place, oftentimes you can just go to your landlord and say, hey, the pipes burst. Hey, the paint is flaking off of the wall. Hey, it looks like maybe there's a leak in the roof. And that's all you have to do. And you're not the one who has to figure it out. You're not the one who has to find a contractor in today's busy world where it is next to impossible to find people to provide help with those kinds of jobs in many places. You're not the one who has to figure out what the best way to deal with it is. Now, different people are going to weigh those pros and cons differently. If you're good at doing your own home maintenance, for example, then you might be much more comfortable owning. If you are really bad at dealing with that maintenance stuff and you just don't, the idea of maintaining your lawn and planting a garden and things like that, it is not the appeal to you, then you may end up not wanting to buy and instead hand that responsibility off to whoever you are renting from. So those, I mean, I could keep going, but I'm not going to. Bro, I'm curious if you feel like weighing in at all on the buy versus rent question. I know you kind of come from a different perspective because you are in a market where home prices for purchase have gone up quite a bit. I don't actually know what in the greater DC area the rental picture looks like, if rents have increased just as much or if rents are reasonably affordable compared to purchasing a home. If you don't mind, tell me a little bit more about that and how that plays into what you're, how you would suggest to somebody in your area how to approach that buy versus rent question.
The honest answer to that question is, because I live in the DC area, which is home to 20% of the federal workforce, I would say hold off on making any major decision related to buying or renting right now. So that's my honest opinion about it. I was just walking around our neighborhood last night. I mean, our neighborhood is full of government employees, government contractors. Mark Esper, Donald Trump's first Secretary of Defense, lived in our neighborhood.
Yeah.
So it's going to be very interesting.
Have the for sale signs gone up yet, bro? Or
no,
yeah.
No, not yet, not
Okay.
yet. But really, it's going to be a very interesting year. I mean, I certainly know people who are very concerned about their jobs for sure. That said, getting back to the main question, I know you talked quite a bit, and I was doing a little bit of research, so I didn't hear everything you said. But I will emphasize one thing that you did say, and that it's partially a financial decision and partially a personal decision. I could go either way personally and living in a rented place or owning a house. My wife loves owning the house. She is by nature a homebody and someone who just loves to do things to the house. I would just say that in terms of the financial aspect, you have to appreciate all the costs of owning the home, which includes taxes, maintenance, insurance. Compare that to renting. And if renting is much cheaper, then make sure you're banking the difference, because with the house, you are building up home equity and you do have a certain amount of inflation protection because your mortgage is fixed and ideally the house will go up. And historically, houses go up at a rate of about 1% above inflation when you factor in all the costs. And that's according to research from David Blanchett, who was formerly of Morningstar. So hopefully that helps with that. I will go ahead and get one question here from Murali. Hopefully I pronounced that correctly. What are your thoughts on index universal life insurance policies? Interesting question. So my thoughts are they're great in theory, but when you dig into the details, you factor in the costs and the illiquidity, they probably don't make much sense. So these are basically cash value life insurance policies. So they provide some life insurance, but also a cash value component. And the cash value is determined by the performance of a certain index. It's very frequently the Dow or the S&P 500. And what the selling point is, if the index goes up, you make money. If the index goes down, you don't lose any money, or you don't lose as much as the index. There's a floor to how much you will lose, so that sounds great, right? Except that you have to understand how they calculate the amount of the participation in the upside and the downside. So what often happens, first of all, is there's a cap. So it'll say you will earn 8%. You'll earn the return of the S&P 500 up to a cap of 8 or 9 or 10%. So last year, the S&P 500 was over 20. You didn't get that. The other thing, generally speaking, is that dividends aren't a part of it. So these days, with dividends relatively low, a little over 1%, that may not be as big of a deal. But know that is not part of it as well. And then you have to understand, are those returns before or after cost? And often they're after cost. And the costs of these policies are often a good 1%, 2%, 3% a year. And that you have to lock your money into these policies as well, right? So it's difficult to get the money out. And if you were doing this purely as insurance, like if you're really looking for insurance, then term is going to be much, much, much cheaper. Although at some point, you can't really get term; it's too expensive. So I'll hit here then into a couple of the pros of really any cash value life insurance policy which would apply to this, right? You could keep this policy for as long as you live, as long as the premiums are being paid. So that's why it's often called a version of permanent life insurance. And it can be a resource in retirement, and a tax-free resource, because you're not taking the money out, you're borrowing the money. And like most loans, borrowing money from your life insurance policy is tax-free, which is great because that you don't pay taxes on it, but there are other things in your retirement that are determined by your gross income, such as the degree to which your Social Security is taxed, how much you pay for Medicare. And you don't have to necessarily pay the loan back. It depends on the policy, but you could just take out the loan, but then when you die, the amount of the outstanding loan, and there is interest associated, is just taken away out of the death benefit. So to sum up, I would say great in theory, but you really have to dig into the details on whether it makes sense and whether it's a good policy. And if the person who's trying to sell this to you started with something like 401ks are a scam, don't use a 401k, go into this type of life insurance policy, then run away, because you'll see that a lot, especially on TikTok and maybe YouTube. These are just salesmen, saleswomen trying to get you buy the life insurance policy. They really don't understand the benefits.
Yeah, I'll just second that. It's one of those things that the product, Bro is right that it's important to dig into the product, but what you will often find is it's really hard to dig into the product. Like, you might end up having a prospectus that's 150 pages long, and there's almost this calculus level math that goes into figuring out what the index, what happens if the index goes up a certain amount or goes down a certain amount, or if company pays a dividend a certain amount. I mean, I've looked at them, and it's tough. It's been tough. Even professionals who kind of understand this language and are versed in the ways that lawyers write prospectuses, even they have trouble figuring out exactly how some of these things work some of the time. And so, in my opinion, life is often too short, and you're better off, there's other ways to kind of protect your risk. For instance, one thing that a lot of people will get these things for is they don't want to lose money. And my view is that if there is a level of losses that you are comfortable with, then there's an asset allocation out there that can generally give you that kind of protection without a whole lot of bells and whistles, without the need for an insurance wrapper that you may not need. Now, as Bro points out, if you actually need the insurance, if the insurance is a valuable part of this, then that can change the calculus. But at the same time, there may be simpler ways to get the life insurance element as well. So that is definitely something to think about. Miss Melanie, 15 minutes ago, asked us, what are the pros and cons of transferring a primary residence into a trust? Does it impact the joint tenancy with rights of survivorship inheritance rules? So Miss Melanie, yes, it does. I'll answer the second question first. Yes, it does. You would not hold an asset if the asset is held by the trust will not have a joint tenancy right of survivorship. Whatever the trust says happens on the death of one of the people involved in the trust, it may be the only person involved in the trust. Whatever the trust instructions are, that is what the trustee will be required to follow when one of the, if you're talking about a spousal situation, which is usually what you're talking about with joint tenancy with rights of survivorship, then when one of the spouses passes away, you look to the trust, and the trust will say whatever happens to potentially that spouse's share. I mean, trust can be written up in any number of ways, but you can mimic the treatment of joint tenancy with rights of survivorship inside of a trust. It's just not going to be that type of titling. It's just going to be in the name of the trust. So more broadly, the pros of transferring a primary residence into a trust are generally the same as, the benefits of transferring any asset into a trust. Not subject to probate generally in the event of a person's death, of an owner's death. Not subject to the the public disclosure rules that are often involved when an asset is part of an estate. And and also it just kind of keeps things, keeping them outside of, well, wait, now I'm getting mixed up here, aren't I? So let me back up for just a minute. So let me start over with the trust pros. The pros of the trust are anonymity in terms of disposition, and because it'll stay in the name of the trust, even if the beneficiary of the trust, the future beneficiary takes over after the present beneficiary passes away. Inside of a trust, you would also potentially avoid the probate question. Now, for some of the negatives, you have to look to state law to make sure. There are some states where an individual or a couple who hold a home in their names, sometimes with a specific or special form of ownership, will qualify for extra benefits, extra pros, things like maybe creditor protection. I know that in my state of Massachusetts, there's a homestead exemption. If you declare your primary residence to be eligible for the homestead exemption, that gives you certain protection from creditors that you wouldn't have absent having that exemption. So it's things like that. You might get a property tax break. And the question becomes, is the state going to be smart enough to realize, especially if this is a revocable trust where you are the person creating the trust, you are the beneficiary of the trust, and you are the person getting the enjoyment of living in the home? In that aspect, nothing has changed. But if the state still looks at it like, well, hey, there's a trust, it's not you, then that might remove your eligibility for some of those positives. And so that's something to think about as well. You're going to need to usually do a special type of real estate deed in order to convey the primary residence into trust. That may require some filing fees. That may require paying your attorney a little bit extra to prepare that real estate deed. Not a huge deal, but it may be enough to, sometimes you might find that it's a tiebreaker. But that's kind of a short view of the pros and cons of dealing with primary residence when you're putting it into a trust.
Steve D asks, have you seen any correlations between the average S&P 500 PE ratios and recessions? The average PE currently is much higher than it has been historically. I haven't seen anything on recessions. It's an interesting question. I was trying to do some quick Googling and I didn't find anything, but it's an interesting question. So I'll look into that later. If I find anything, I'll bring it up on a future Fool24 show. But what I do know is that there are correlations between valuations and the subsequent returns over 7 to 10 years. So not over the next year, not even the next 2 or 3 years. But there is no question that there is a very strong correlation. Well, I should say a moderate correlation between starting valuations and returns over the next decade or so. And we are in high valuations, right? Goldman Sachs got some attention earlier this year saying they predict that over the next decade, at least this part of Goldman Sachs, it's a big bank, a lot of people there, but they put out a report saying that valuations for the S&P 500 are in the highest 7%, and they predict that on average the S&P 500 will return 3% a year over the next decade. That is, pretty stark, not very exciting, and I have shared all kinds of different projections for different asset classes over the years from Wall Street. Many firms produce what they call their capital market assumptions, either toward the end of the year or the beginning of another year. Christine Benz of Morningstar does a great job of summarizing them every January, saying, well, this is what people are saying now. So really, ever since Fool Live began 5 years ago, I would present these and I'm just saying, this is what people are thinking. And every year, they pretty much said the same thing. U.S. stocks would underperform the rest of the world because U.S. stocks are so expensive. Small caps would outperform large caps because large caps have become so expensive. And value would outperform growth, mostly. There's some firms who had different opinions, but that was generally how it's been. And of course, ever since that, it's the complete opposite is what has happened, right? So I don't know. I will say I take valuation into consideration a little bit when I am rebalancing my portfolio every year. maybe selling a little bit of what has done particularly well and become more expensive to buy some assets that are underweighted. And now that I am within a decade of retirement, I'm doing a little bit more rebalancing into cash and bonds. What I do pay attention to is something like I said at the very beginning of the podcast, or the podcast. Sorry, I also do the Motley Fool Money podcast, by the way. At Fool24, I do pay attention to things like the inverted yield curve, because it does indicate that the economy is slowing down. Does that mean I sell my stocks? Not necessarily. What it really means is, for me, as someone who has a job, is that it's my time to think of like battening down the hatches a little bit. Because for most people, the biggest risk in a recession is job security, right? If you are living off your portfolio, if you are retired, ideally you have at least the money you need in the next 5 years out of the stock market in cash and bonds, maybe even more if you are a more moderate to conservative investor. So ideally, you'll be able to ride out the storm. If you're not yet retired and your portfolio goes down, that's actually good news, because that means all future contributions to your IRA and 401k will go in at cheaper prices. For those who are working and relying on a paycheck, the biggest risk of a recession is income security. And we're seeing that now. Of course, a lot of what's happening has nothing to do with the recession. It has to do with other things going on. So that's why I've mentioned in other shows, I think it's a great time to use a tool to really evaluate your budget and see, are you spending money in ways that are really important to you? For ways that are maybe a little bit more frivolous, it might make sense to be building up a little bit more cash, building up your emergency fund.
I'll just say that I think if you'd gone back to 2015, you could probably find one of those predictions that Bro was saying. You know, at that point, we'd had 6 years of bull market after the 2009 lows, and it would have been a perfectly reasonable thing to say and to look at and to say, yep, U.S. stocks likely to underperform long-term averages over the next decade. International stocks likely to outperform. And, we all know that has not really been the case. So, prognostications, I mean, statistics will tell you that just because a prediction is wrong just because the prediction doesn't turn out the way that you expected it to, doesn't necessarily mean that the prediction was wrong. A lot of it has to do with the fact that people make predictions as though they are 100% probable to happen, and that's never the case. If somebody tells me that there's a certain percentage chance, yes, it becomes almost meaningless in the eyes of many, because essentially you always have an out. It's kind of like the famous 30% chance of rain in the afternoon. It's kind of like, well, help me out here. I mean, what does this mean? It means that somebody's going to get the rain, but it's probably not you unless you don't want it, in which case you'll get it. But so it's a tough business, the prognostication business. You just do the best that you can. Bhavesh Shah with a question 10 minutes ago. Is it true when kids receive taxable capital gain stock in a brokerage account and real estate as an inheritance, then the value is calculated as a stepped up value and therefore save on capital gains tax? Bhavesh, often it is indeed the case. If someone, say, if someone had assets in a taxable brokerage account and they pass away, and those assets are in their name, and so it would be includable in their estate. Estate taxes are such that you have to have a $14 million estate before you even really have to start thinking about whether you're going to owe estate tax. And so a lot of people have a tax, they have an estate and their assets are going to go through it, but they're never going to realize it because they're not going to owe estate tax, because the current estate tax exemption is so high. But that's the rule that technically applies here, is if the assets are part of what would be your taxable estate for estate planning purposes, for purposes of federal estate tax, then they will be eligible for a step up in basis, because it's a taxable brokerage account. And so as a result of that, the value of the assets that a child or any other beneficiary would get is going to be adjusted to whatever the fair market value of that asset was on the date of the original owner's death. what that does in practice is that if a person held a stock for 10 years, 20 years, something like that, and it's gone way up and they pass away and it goes to an heir, that heir generally has very little capital gains tax because you're not looking back 5, 10, 20 years to what the value of that was back then. Instead, you're just looking back a few weeks or a few months to whenever the person passed away. In general, that's not necessarily going to be a big movement. And so as a result, the tax impact, if the child ends up selling it, the tax impact ends up being relatively minimized. And so that can be, that can be a really beneficial way of handling these things. Consider the contrasting situation where a person sells their stocks immediately before they pass away. Then suddenly they have on their final after death tax return, they're going to have a big capital gain to pay. And depending on their tax bracket, that could be a whole lot more money than the next to nothing that an heir would have paid if that heir had just been allowed to inherit the asset rather than the person who passed away selling out immediately beforehand.
We still have about 13 minutes left to our retirement show, financial planning Q&A. So if you have a question, get that in. We'll probably have a chance to answer it. I'll just add something to what Dan said. We often get the question of, okay, I've retired. I have multiple types of accounts. I have a taxable brokerage. I have a traditional accounts. I have Roth accounts. Which should I tap first? And most studies indicate that you're better off tapping the taxable brokerage account first and then going into the tax advantage retirement accounts. But that order reverses itself as you get older and you have stocks or whatever in your taxable brokerage account, and they're going to go to your kids. At that point, you probably should leave them alone, depending on your situation and the investment merit and all that stuff, of course, because by leaving them to your kids, you'll have avoided having to pay all those capital gains. All right, a question here is, what is the best way to hold cash? The answer is very tightly. No, I'm just kidding. I'm going to assume your question is about where to find the best yielding cash. But if it is more about which account, please let me know. These days, if you just go to your regular old bank, you're probably going to get maybe 1% on a savings account, maybe, and nothing on checking. But if you put in more effort, look beyond your regular bank or ask your regular bank what are the better options, you should be able to get something over 3%, if not 4%. The Motley Fool has a website called Motley Fool Money, which highlights higher yielding savings accounts, higher yielding CDs. These days, also money market funds are still generally yielding over 4%. I will highlight the difference between a bank account, like a savings account, and a CD, which is FDIC insured, as our money market accounts. Money market funds are not FDIC insured. So there is technically a little bit more risk with them. Historically, there's only been a couple that have had issues, but it is still a possibility. So if you're looking for FDIC insurance, stick with something from the bank up to the certain limits. And the FDIC does have a tool, actually, that will help you analyze whether your savings accounts are covered by enough FDIC insurance. It's their EDI tool. EDI stands for Electronic Deposit Insurance Estimator, I think. You could do an online search for that and find it. And the other thing I'll say, too, it's the same with your brokerage accounts. The default cash option in many brokerage accounts are ridiculously low. So don't let the cash just sit there. Look for a high-yielding option if it's available. Just know that you are choosing something like a treasury ETF, for example, like SGOV, which is a very popular short-term treasury bill ETF, one that I personally own, has a yield over 4%. Just know that if it's not exactly the same as cash, right? Because if you want to use that cash to buy another investment, you have to sell that first, wait for it to settle, and then use it. So that's just some other consideration too. Some other thing to consider as you're determining where to put your safer money.
All right. Jimbo has a question. If you want to add bonds to your portfolio, what would you add? Midterm, long term, in view of inflation trending down in the long term? Jimbo, I have an unpopular opinion. I don't think that if you force me to prognosticate, I would say that I don't think inflation is going to trend down. And the reason for that is just that I have some uncertainty about the economic policies that I'm starting to see both here in the US and abroad. And it just doesn't seem to me like there is the political will to control inflation in the way that I've seen in the past. Maybe it's just been too long. I mean, the bout of inflation that we got a couple of years ago was really very short compared to what we saw in the 70s and early 80s. And that's just been too long ago. I mean, it's 40, 50 years ago. There aren't as many people around who remember what that was like. There aren't as many people who remember that, it wasn't just a matter of what you were paying for things. It was a matter of, government policy. It was a matter of, I mean, if you wanted to buy a home, you're paying double-digit interest rates. I mean, that just wrought havoc with affordability really across the economy. And so, by contrast, the couple of years that we saw, it seems like a blip by comparison. And so, but what I'm seeing is that, yes, we've made substantial progress in fighting against inflation, but I don't see the same commitment to, the 2% target that the Fed has done. The Fed's getting a lot of pressure from government officials. Nothing new there. The Fed has gotten this kind of pressure before, albeit in different ways. But I think that a lot of people want interest rates to fall so that the economy can, because lower interest rates has typically meant stronger economic growth, but it has also typically meant more inflationary pressure. And so I just think that there's, almost this consensus that, that 2% target, well, maybe it should be 2.5, maybe it should be 3. We should be happy with 2.5 or 3. And if we're happy with 2.5 or 3, then, the next time it happens, then maybe we're happy with 3.5 or 4. And so as a result of that, to answer the question directly, if I am adding bonds, and in fact, I have been buying bonds, what would I add? I have been adding Treasury inflation protected securities, because the implied inflation rate on those Treasury inflation protected securities, when you take the real yield before adding the inflation component, when you compare that to the yield on a conventional Treasury bond that doesn't have inflation protection, it's all baked into the interest rate. When you compare the yields on those two different types of bonds and you kind of do the math, where you end up is like this 2.5% assumption. Now, if I'm wrong and the Fed does eventually get us back down to 2%, then I'm going to be a net loser here. I would have been better off buying a conventional bond with 2% inflation than I would buying an inflation protected security where the implicit assumption based on current market rates is an inflation rate closer to 2.5%. But if inflation is 3%, 4%, something like that over the period of the bond, then I'm going to be the winner, because I'm going to have done better off than I would have if I bought a traditional non-inflation protected security, whether it is a treasury bond or a CD from a bank, an insured CD at a bank. The same amount of credit risk involved. It's just the full faith and credit of the U.S. government. But that's kind of because I'm questioning the thesis behind your question of, in view of inflation trending down in the long term, that's kind of where I get with that. I think if I agreed with you and I thought inflation was trending down, then yes, those long-term interest rates would presumably fall. And if they do fall, then you're going to get some price appreciation in addition to the yields that you're getting, which are well above 4% right now.
I'll just add on to that something I've mentioned in the show before. Dan is absolutely right. If interest rates go down, long-term bonds will benefit the most. But generally speaking, if you were just looking at this as a situation, like, I have no opinion on whether rates are going up or down. Historically, long-term bonds have had very poor risk-adjusted returns, very volatile for the additional interest that you get by buying, say, a 20 or 30-year treasury versus what you get on a 10-year. And that's particularly true now, right? The extra yield you get is virtually nothing. So if you were very convinced interest rates are going down, yes, long-term bonds are the place to be. If you don't have a strong opinion, over the long term, short and intermediate term bonds have the best risk-adjusted profiles. And that's what I've also been doing. Short-term, intermediate term. I totally agree with Dan's take on TIPS. TIPS funds don't have quite the same certainty and much more volatile. Dan, if you don't mind me asking, are you talking about individual TIPS or are you buying TIPS ETFs?
I buy individual TIPS. Yeah, I'm getting them through some at auction through Treasury Direct and some just secondary market purchase through my brokerage accounts. But yeah, and I'll second what you're saying with respect to those long-term bonds. It's a trade, and it is something that you have to deal with a lot of volatility. Turn back the clock to, was it 2022? I think it was, when both stocks and bonds were down. If you took a ETF like it's the iShares 20+ year Treasury bond ETF, which is ticker TLT, if I'm remembering right.
Yep.
Like that just plunged. I mean, people were sort of like, wait, this is a bond fund. How the heck is it going down like this? And it's because of exactly what Bro said. Those long-term bonds, those prices change a lot. Like, even if the interest rate goes up just like 0.25%, then those bond prices can fall quite a bit on the long-term bonds. And you'll remember, I mean, we got quarter point after quarter point after quarter point after quarter point. I mean, it just went on and on and on. And so, yeah, those long-term bond ETFs, they got hit in ways that, people never seen before. And so, yeah, you got to be really careful and have that conviction and have some risk management in there just in case you're wrong, in order to make sure that long-term bond bet doesn't sour on you.
Yeah, I looked it up. So, 2022 was a bad year for stocks. S&P 500 down 18%. TLT, the long-term treasury ETF, down 31%.
And Vihan asking for some clarification on exactly which QSIPs I've been buying. Yeah, it's I'll tell you this, Vihan, the auctions, the treasury auctions, new TIPS or reopen TIPS once a month. And the terms vary. Sometimes it's 10 years, sometimes it's 30 years, sometimes it is 5 year. I don't participate in all of those auctions, but I have participated in some of them. And then, the other thing that I often look for when I'm looking at secondary bonds is sometimes you will pay a lot less and get a much higher yield if you buy like sort of an oddball maturity. So, like everybody loves 10-year bonds, but you may get a better rate if you buy a 9-year bond or an 11-year bond, because the pros aren't paying as much attention to that. And so if I have an ability to, sort of like, selling your car, trading in your car after 3 years, you still get a pretty good trade in. But if you wait beyond that, maybe it doesn't work as well. It's kind of the same thing. If you pick these up when everybody else is trying to sell them, sometimes you get a better deal.
We're almost at the end of the show. I do want to highlight a resource that I often highlight when we're talking about TIPS or iBonds, and that is tipswatch.com. It's just a site run by a journalist named David Anna in North Carolina, I believe. But he's been investing in TIPS since the 90s, and he just provides an enormous amount of commentary, but also just instructions on how the TIPS market works and iBonds. I agree with Dan, by the way, too, that iBonds were very hot for a while, but right now TIPS are priced probably more attractively. iBonds, I think the real rate on iBonds now is maybe 1.3%, whereas TIPS you're talking about maybe earning over 2% real being inflation adjusted. So if you're not familiar with the TIPS market, especially when it comes to buying individual TIPS, highly recommend tipswatch.com as a resource. And I think that is it for the afternoon retirement show, at least afternoon here on the West or the East Coast. But now we're going to turn it over to Lou and Danny. Full on, everybody.
Have a good day, fools.
Well, thanks, gents, for an informative retirement show. My name is Danny Venna, and I will be joined here by Lou Whiteman, who seems to be having some technical difficulties, but I imagine will be back with us very shortly. In the meantime, we're going to be talking about stocks for the long term. This is a subject that is kind of near and dear to my heart. I learned early on hanging out with the Fool as a subscriber, and then as a commentator that I kind of have the long term buy and hold bug. Got it from early on. And now, I couldn't imagine, trading stocks or buying them and not holding them for, at least 3 to 5 years. So that's kind of, that's my view on the situation here from sunny San Diego as a former stock advisor and Rule Breakers subscriber, and now a Motley Fool contributor. How about you, Lou?
Yeah, yeah. Hey, Danny. What Danny was trying to say with that subtle sunny San Diego is that there are a lot of fun things to do in life beyond look at the stock market. And fools, I don't mean to sound otherwise. I am so happy to be here with Danny right now. I am so happy to talk stocks. I do enjoy all of this, but you know what? Only enjoy it so much, and I like other things too. And I love this stock for the long-term thing because quite frankly, I'm not going to sit here and tell you can't get rich day trading. I'm not going to sit here and tell you can't find ways to get rich with options and things like that, and buying stocks that could go up 30% or down 30% this year or triple or stuff. But that's a lot of work and a lot of time in front of a machine. And I personally, for me, would much rather just find something that I can just check in on every now and then, focus on thinking about 5 to 10 years, not 5 to 10 minutes. And, whether you're in sunny San Diego or slightly less sunny, but maybe spring is beginning to begin Atlanta. I'm my bias is that you will do better if you focus on the long run, period. And that's why I do it that way. I'm being a little flip. If I really thought I could outperform and, generate $1 billion a year by obsessively hitting refresh on and doing 2-minute trades, knowing me, I'd probably do that. But I believe that the best way to make money is to find good companies and get invested in them and then go walk your dog and not worry about it, or go on vacation, or turn off the computer for a bit and just check in every now and then. And so when I think stocks for the long term, and I think it's funny because Danny and Danny, I don't want to put words in your mouth, but we tend to gravitate towards different companies. I don't think our investing style is exactly alike, but I think this is one place where we are aligned, where I don't see Danny doing a lot of like, okay, we're just going to jump into this one at 9:30 and hope to be out of it by 10, stuff like that. I would much rather try and find a company that is set up to inherit the earth over the next 5 to 10 years and just go along for the ride. That's, I don't know. I think it's a better way.
And not only do I believe that, but I think a lot of the evidence in my portfolio is somewhat compelling. So I'm going to go back and look at the stocks that I hold that represent the biggest parts of my portfolio, and perhaps when I first started investing them. Netflix, which is my largest position, represents about 14% of my portfolio. I've started buying that stock in late 2007. Started buying Apple in early 2008. Chipotle in later 2008. Mercado Libre early 2009. Let's see here. Now, Nvidia is a later one. I didn't start buying Nvidia until 2018. and yet it's become one of my largest holdings. And I think the point here is, you were talking about people jumping into and out of stocks, in by 9:30 and out by 10. I think some of the stocks that I have sold the soonest were ones that I held for 3 years. I recently divested myself of some of the stocks that I bought early in the pandemic that I thought were going to be market beaters for the long term. And it didn't necessarily turn out that way. And that's okay, because not every stock you own is going to be a big winner or a multi-bagger. But if you focus on quality companies that have a strong track record, that deliver growing revenue and profits quarter in and quarter out, year after year after year, what you will find is that some of your stocks will grow to 10 times your original investment. Some will only go up a few times. Some will lose money. But we were talking about this a little bit yesterday. If I own a stock and it goes to zero, I've only lost 100% of what I put into it. Another stock, it can grow 10 times what I've done, and that more than makes up for the one that went to zero. And I very rarely have a stock go to zero, although I have some in my portfolio still that are down 80 or 90%. But the ones that have multi-bagged and gone up 8 or 9 or 10 times their original, or 33 or 100 times their original value, far outweigh the ones that I lost money on.
Yeah. Yeah. And that's important to say, is that, they all don't work out like Nvidia. And that's okay as long as a couple work out. I mean, look, I have never owned. I mean, I own Mercado Libre. Dan, I'm trying to think back to the stocks you said. I don't own most of those, and I will stand by the returns of my portfolio. You can get over time a lot of gains one way or the other, and that's kind of part of the fun here, is that there's a lot of ways to do that. One of the ways, and to kind of get into questions, and but before we get into questions, I have to hit this one because he's kissing up, or he or she kissing up, because Mrs. and I, Random Lake says, Lou speaks the truth. Obviously I'm going to repeat that, Danny, if you say that. But the Mrs. and I just returned to a 9 days in Hawaii for an anniversary trip. No news or markets, and now a member of the Hawaiian Shirt Club. So something kind of kissing up both of us. Random Lake, obviously, any questions you have, Danny and I will get to now immediately. But turning Jimbo, it kind of fits into this stocks for the long term. But even though it's not zero stocks, but as do you have any bonds in your portfolio? And this is, since it's a long-term perspective, we're coming off the retirement show. Those guys, and I know Dan Cap was just talking about treasuries, which is something similar in terms of an income thing. The technical answer for me is yes, I do, because I have more than half of my net worth in a variety of index funds, including some that are target funds through my wife's retirement, my retirement, and my daughter's college, and they all have a bond element. I am open to bonds. I don't really like bond funds and bond ETFs because, as I think the guys were talking about last hour, one of the things about bonds is that when rates go up, because it's a fixed return, the price of the bonds in the secondary market go down. That's fine if you're holding a bond to maturity, because what it does is level off your return. But if you're in a fund that's buying and selling bonds constantly, the price can really, really hit you. So I am resigned to the fact that I will have bonds in my portfolio one day, but I do not actively seek bonds because I don't really feel like doing the work on them, and it is a separate work. And I don't really find bond funds all that appealing. Mutual funds are a little better at ETFs. I will say this too, depending on where you are in the process, there are a lot of income generating opportunities. For me, the first step, being in my 50s and thinking about income a little more, is stocks with solid dividend yields, financials, REITs. I'm not going to begin to tell you that they are a like for bonds. And I don't think you should do it that way. There are a lot of things that make bonds more attractive, but there are downsides to bonds too. And I think as on the glide path, I am much more interested in just kind of cash and income generating stocks and putting off bonds almost, but putting off bonds the way you put off doctor's appointments when you get older. Let's put it that way. I don't know, Danny. Are you the bond king too? I mean, PIMCO is right around the corner. We're right up the road for you. They are the bond kings.
You know, and I never got the bond bug. When I first joined the Motley Fool, I found that I was more comfortable and more aligned with the David Gardner style of investing. So more into rule breakeries, tech-centric kind of stocks. And when I look at bonds, what I see is a vehicle that delivers more consistent, more dependable returns that are much lower. And I'll give you just a little bit more about my history than you probably care about. But I spent 13 years in the military, not too long out of high school. By the time I decided that I better figure out what I want to do when I grow up, and got out of the military, I had no pension, I had no savings, I had no retirement funds. And so I thought, if I don't want to eat cat food in retirement, I need to focus on a more aggressive style of investing. And that has worked out well for me. I would not recommend it for everyone, but it worked for me. And so I'm not necessarily interested in adding bonds just for the sake of adding bonds. In fact, longtime Motley Fool members will remember that probably a decade or so ago, maybe a little longer, the Motley Fool had an exercise called Supernova. And what we did was we had a number of portfolios that were designed around building out your funds, and then as part of the exercise saying, okay, now we've gotten to the amount that we wanted to get to in retirement. Now we're going to liquidate some of the holdings in the portfolio at regular intervals to simulate, I think it was about $40,000 a year in retirement, in funds to fund your retirement. And that exercise was really educational for me. And it also proved to me that I don't necessarily need bonds in order to have a stable income flow in my retirement. So that's much more than what you wanted to hear, but it's kind of what is behind my mindset.
I like it. I like it. All right, where are you going next, Danny?
So we have from Jimbo has a question. Nvidia is one for the long term or medium term. How big a market cap do you think it will have in 3, 5, or 10 years? I don't know. I know if you want to see some really good prognosticating, I would recommend going back into Fool24 and looking at the last hour of the day yesterday. That was Nvidia, kind of a deeper dive into their earnings that was hosted by Toby Bordelon and Jose Najarro. And Jose was the one who had predicted what Nvidia's earnings projection would be, forecast would be for the coming quarter, and how much the company would deliver in revenue for the current quarter. And they had this discussion. They talked a little bit about where Nvidia would be several years from now, and perhaps it was Jimbo that asked the question. But they made a good point. If you go back to say 2020 and ask somebody how many stocks can you pick that will be worth $3 trillion or more several years from now, or more than $1 trillion several years from now. That is a difficult task. But I think that Nvidia has the potential to be worth much more than it is today. If you had to pin me down, there are some folks out there that are much smarter than I am that are predicting that Nvidia could be worth as much as $10 trillion by 2030. And if you're interested in reading a little more on that, one of those comes courtesy of Beth Kindig, who is the founder of the IO Fund and analyst extraordinaire. And I think she makes a good case for that. So is it possible that Nvidia could be worth that? Sure enough. Will it be? I don't know the answer to that, but I do know that Nvidia is the second largest holding in my portfolio behind Netflix. And at least in the near term, over the next several years, I don't plan on selling any of those shares. Lou?
Yeah. It's funny. I mean, I don't know is the right answer, and I like that answer. I think my gut is I probably am more bullish on the shares in the short term, in the long term, than I am the medium term. And I intentionally am going to be vague there because I think in the short term, it's almost random. And there's always the possibility that things could jump well beyond like what analysis suggests in the short term. Over the long term, I think Nvidia has a ton of opportunities. In the so-called medium term, whatever it is possible that we'll go through a flat few periods because a lot of growth has been pulled forward. So I think I don't worry about that as far as a sleep at night, and I think it could do anything in the near term. It's that middle term that we'll have to see, because whether or not this current momentum continues or it takes a breath is, to me, the hardest thing to see. All right, I want to get to a few, Danny. We have to finish off the hour, I think, since we did this, at some point we get to Shimon's about to talk about actual stocks for the long term and come up with those. But we have time on that. I wanted to get to one that's a little out of my bailiwick, but we are a service here, trying to provide a service, and I think I can kind of do that. Cyber Mikey said, I'd like to add Bitcoin to my retirement accounts, but only crypto ETFs are allowed. Do FBTC, which is one of the big Bitcoin ETFs, and other platform, do they offer the same as the cryptocurrency? I think is what they're asking. And we can look at that literally. And I think that's the only thing we can do. And remember, ETFs are separately traded products. So they trade based on supply and demand, just like a stock does. So they are not required to be a one for one. Like if Bitcoin goes up 0.7%, the ETFs are going to go up 0.7%. There is going to be some wiggle, but obviously the managers are going to try to do what it states in their thing. And if they state in their prospectus, we are going to try to track Bitcoin, that's what they're going to try and do. But Natasha, if you can pull up the screen, this is just a 1-year chart. The purple line, I know it's very crowded, but I wanted to put a bunch of them in. The purple line is the price of Bitcoin over the past year. The other 4 lines are the 4 largest right now Bitcoin ETFs. The Fidelity one that you were talking about is right there in the orange line. So I would say it did a pretty good job tracking it. But again, you'll notice directionally, it definitely worked, but down to the decimal point, it didn't. Another way to do that is MicroStrategy, which is buying Bitcoin. And you'll notice that MicroStrategies can't see, no matter how many shares they sell, they can't seem to get their way. They can't get parity with the Bitcoin they own. So it's really hard to track one for one. These ETFs are by their nature not going to be exactly the Bitcoin, because again, if Danny and I both want to buy an ETF and there's nobody selling it, the ETF price is going to go up kind of independently of that separate trade for Bitcoin at any given moment. But directionally, if you want exposure, they do seem to follow along. And the Fidelity one, if anything, is better than most. So, take that for a grain of salt, but just looking at the data, looking at the chart, that's how it looks.
Fair enough. And I have a very small position in Bitcoin after conversations with my buddy Jason Hall and his bullish thesis on Bitcoin. I bought a small amount. I bought it through a PayPal account, and I just hold it for the sake of having something that's a little bit different. If you look at my portfolio, I have some railroad stocks. I have some toy makers. I have some restaurant stocks, just to kind of balance out the tech-centric nature of my portfolio. Vihan says, you noted Nvidia, ticker NVDA, is a big position. If it's 10%, you being a fan of David Gardner rule breaker style, would you mind adding to winner Nvidia here or find another opportunity? So what I'm about to say is just me personally, and how I view life. So I bought Nvidia numerous times over a several year period. And I built it up to where I had the amount of money in the stock that I wanted to have into it. And the rest of that has come from Nvidia's, stratospheric gains over the past few years. I'm looking across multiple portfolios. Nvidia represents about 11% of my entire stock holdings. And that entire position is up about 860% from my cost basis. Now, when I get a stock that's already 11% of my portfolio, David Gardner and rule breakery leanings aside, I don't feel like it's necessary for me to add any more to it. The stock is already doing the heavy lifting. I think that has a great future. And in the meanwhile, while that is, continuing to go up, I can add to other stocks that I believe will be the next generation of potential winners. And just to give you a little context on my views on Nvidia, I believe that Nvidia is tapping into one of the biggest secular tailwinds that I might see in my lifetime. And that's one of the reasons that I am so hesitant to sell. And I, like Lou, believe that this is going to be a roller coaster ride. In fact, I wouldn't be surprised if Nvidia stock loses more than 50% of its value at some point over the next several years. And history supports me on that. If you go back and look, it wasn't terribly long ago, Nvidia lost 66% of its value during the downturn. So that said, I also think that the stock could go up multifold in the years to come, even after a 50% decline. So I think it has a great long-term opportunity. It has strong secular tailwinds. Management continues to execute in a way that's enviable for a lot of other companies. So I'm not adding to Nvidia here. I've added to that winner enough, and now I'm going to add to others. Lou?
Makes sense. Makes sense. All right. Matt asked me, directed one at me that it's kind of difficult to answer, but I like the question. So I'm going to go at it. Lou, even though they're both currently pre-revenue or mostly pre-revenue, and that's accurate, do you think that the futures of both Joby and Archer, ACHR, look brighter than Boeing's BA? And okay, this is a fun question. And in a way, Matt, we are comparing apples and oranges. Boeing, I think we all know what that is. It is the one half of a global duopoly on commercial airlines, and by itself, even if you carve out the defense contractor just as separate, which a defense contractor is only about 20% of revenue, that defense business would still rank as a top 5 U.S. defense contractor on its own, versus two companies that are eVTOL companies, flying taxi companies. They look like little airplanes, but they're battery powered. They have and they can as the name implies, vertical takeoff and landing is VOTL. They can go straight up and straight down. They're kind of, and this isn't, I got yelled at the other day by a aerospace engineer for making this comparison. And yes, it's a rough comparison, but their total addressable market is helicopters plus. Helicopters are still relatively dangerous. They are tough to operate. They don't work great in weather. This kind of fills the niche that helicopters fill, but in theory, thanks to the wings and just the natural kind of aerodynamics of it, should be more stable, and so open it up to more uses. It sounds like sci-fi. We're not going to have a flying car in our driveways. It's going to be operated by services and stuff like that. Maybe even an Uber version one day. But it is real. The technology is established. It's just a matter of getting FAA to sign off on a new aircraft type. And it is coming as soon as next year. You are going to see these in the sky. And I really believe that. This is not speculative technology. I would also say that Joby and Archer are the two of a wide variety. Danny, this sector had, I think, 8 or 9 SPACs. And these are 2 of them. But and a few of them are already gone. Some of them are going. Trust me. I mean, there are zeros in this. Both of these look like the 2 horses that if you back them, those were the smart choices. So in a way, you use the word future and not like revenue growth and stuff like that, which kind of makes it easier for me. But the future is bright for these guys. I think both of them have a viable business. That said, I do think that we are going to move from a world where the Dannys of the world are invested to the me's of the world. And this is what I mean by this. And Danny, I'm giving you a hard time. I'm giving me a hard time too. But right now, they are pre-revenue, which means they are valued based on your imagination. And I don't mean that to be a snit. Okay. I mean, there are companies that, have worlds to conquer and haven't conquered them yet, tend to be trade on the power of the PowerPoint slide. Once they start churning out product and generating revenues, and we get to see exactly how profitable down to the penny each unit sale is. And remember, this isn't like software. There's a lot of components and a lot of engineering and a lot of labor that goes into these things. All of a sudden, we're going to value this as an aerospace business instead of as a dream. And if past is a guide, it is going to shift the shareholder base away from tech enthusiasts hoping for innovation to kind of boring old aerospace investors. And that shareholder shift could be volatile. So I don't know how bright the future is for these stocks over the next year and a half. Relative to Boeing, I would rather have Boeing's assets. I mean, Boeing should rule the world as they once did with the power of their portfolio. They just can't execute. So I can't tell you what the future is for Boeing, because just like with GE a few years ago, when every quarter there was a one more thing, and it wasn't a Steve Jobs one more thing, it was the other way around, where one more thing, this is broken too. We went through that for what, 5, 6, 7 years with GE. We're on year 3 or 4 for Boeing. If and when they get their act together, assuming they're still treading water, they're able to tread water through it, I would rather have those assets and see what you can do with it. But I think for an investment right now, I don't know why one of these eVTOLs couldn't do better over the next 5 years than Boeing, given all of the mess that Boeing has to climb out of. So I don't think I really answered your question, but that is some thoughts on the question. I think they all could make it from here, and it's just perception versus reality more than anything right now for all of them, if I'm honest. All right, Danny, before you get in your flying car, what else you got?
Before I get in my flying car with my Hawaiian shirt. So just a quick comment here from Let Your Winners Win, I believe. LY Winners Win. Danny, I agree with your mindset. Maybe not for everyone. No bonds for me. Long-term holds over decades include Microsoft, Starbucks, Cisco, Nvidia, CAT, RPM I'm not familiar with, and a 500 index. So tickers MSFT, SBUX, CSCO, NVDA, CAT, RPM, and an S&P 500 index. Not surprisingly to me, I actually own 3 of those, which are Microsoft, Starbucks, and Nvidia. Do you own any of those, Lou?
Let's see.
Cat?
No, I don't own any of them anymore. I finally gave up on Microsoft as part of just the Mag 7 is everywhere. Like you were saying, you're at my Nvidia position, Danny, despite not owning any Nvidia. It's about 2% of my total portfolio. So, no. And of those, RPM, by the way, that's a sealant company. So that's an aerospace or kind of aerospace manufacturing company.
Okay.
Building materials, sealants, things like that.
So yeah, I see several companies there that I think have done well in the past and could potentially do well in the future. As I said, I own Microsoft and Starbucks and Nvidia. So congrats on your long-term holds over decades. I think for me that long-term holding is the way to go. Fabiolo Gascoigne Esqueda, I hope I am pronouncing that correctly, says, I'm relatively new to the stock market, interested in long-term investing. Do you have any book recommendations for learning solid beginner principles? I'll tell you what, I'm just gonna reach over here for a moment. When it comes to mindset for long-term investors, I'm going to plug our friend and former Motley Fool guy, Morgan Housel, The Psychology of Money. I believe for anyone who wants to learn how to be a successful investor, this book should be required reading. And essentially, it tells you that the most important part of being a long-term buy and hold investor is knowing that time is on your side, history has your back, and the most important thing to learn as an investor is to be able to sit on your hands and not buy and sell and buy and sell and buy and sell. That is one of my favorite investing books. I think another one, let's see.
So I will say, just as Danny does this, a plug
Sure.
for that book, Fools, as some of you know from the old days that I work up at I help out at a high school too. I just decided I'm getting every senior that is getting a copy of that book as a graduation gift for me. That's my endorsement of that book. That's how much I think. And it's mostly just because I want my idiot daughter to read it, if I'm honest. And I figure maybe if her friends read it too, that she will. But yeah,
Hope she never
but
watches this.
that is what I think. It's almost like putting fluoride in the water for me. I just think that we ought to issue that book to every person and make them read it. And I'm only being a little over the top there. But go ahead, Danny. What else recently?
I think one other book that is really an investor favorite is One Up on Wall Street by legendary investor Peter Lynch. And the reason I think that book is important is because he lays out in nauseating detail the advantages that the everyday investor has over professionals and how they can use those advantages to achieve financial success. And I'm stealing that from something that I'm reading on the Rhine right now. But that is a really good it encapsulates what that book is about. And again, we as individual investors have advantages that mutual funds, exchange traded funds, hedge funds don't have. Hedge funds and these other funds, they're looking to justify their existence by being able to show what they've done in a particular quarter and whether or not that beat the benchmarks during that particular time frame. And that can be detrimental to long-term returns. So the advantage that we have as individual investors is you buy a stock, you stick it in your portfolio, you leave it there, and resist the temptation to sell it during the daily machinations of the market. Excuse me. You resist the temptation to sell because perhaps they had one bad quarter or they had results that didn't meet Wall Street's expectations, and you hang on to them for dear life. And the ability to do that is our greatest advantage as individual investors. We're not trying to meet some artificial benchmarks. We're not trying to beat some benchmark by 1 quarter or 2 quarters or even just a year. If we hold for 3 to 5 years, history shows that if we've chosen quality stocks, that over the long term, you're going to beat not only all these funds, but also investors that hop into and out of stocks for short-term gains.
So I will give two kind of more obscure, but just if people are interested, as far as the long-term investing mindset or understanding kind of why you play the long game. Howard Marks, the famous CEO of Oak Tree Capital, who is the greatest value investor of our time, with all due respect to Buffett and all those other people to talk about, he wrote something called The Most Important Thing. I would consider that essential reading. Not really an investment book as far as learning like mindset and something. I love what Danny said, but if you're just kind of interested about how the market works, and this is and I like this one because it explains market plumbing in such a way that it's actually a great drama. But for those of us old people who remember the long-term capital management, the hedge fund that kind of got huge and blew up back in the late 80s, early 90s. Roger Lowenstein, who's a great writer, wrote something called When Genius Failed. And it is both a great drama, but it's a historical telling of what really happened. And it really gets into the plumbing. And sort of like in the same way what Michael Lewis and The Big Short did. It is just a fantastic read if you're into markets, and a great story told by a great writer. So yeah, that's a little more obscure, a little more, it might be before a lot of people were engaged, but it is just a great story to read. I wanted to hit, Vihan asked, gentlemen, for stocks that you own, which are down 80 to 90%, how comfortable are you buying them now at a discounted better value for potential turnaround later? This is one of those, and I think maybe Danny has a different answer, but I can't imagine a different answer. So Danny, I'll put you on the spot. It depends. I think that is the right answer there. I will tell you, I just looked at my portfolio. I have 2 stocks that currently get that ripe designation. And Vihan, this is just a way of getting us to shame ourselves and say, yes, not everything in our portfolios go straight up. For me, it is TPI Composites, the wind turbine company, and Chegg, which I think we know what's going on there. For both of them, I am not comfortable adding at a discounted better value because I think I have information now that I didn't have when I bought it, and I don't think my thesis is intact. I will tell you though, the next on my list, it's not down nearly that much, but it's down about 50%, is Endava, DAVA, the tech consulting company. That one I did add to when I think it was down lower than that. It was actually considerably lower than where it was now, I think. But after its big fall last year, because that one, I'm wrong so far, but I still sort of buy my thesis. So, I mean, when things are down 80 to 90%, my history suggests, or my experience suggests that probably the reasons I bought it haven't worked out. It's not just a slump, but I don't think I can make a hard, fast rule because I think it really does. It depends on the situation.
I absolutely agree with nearly every single thing you said. When I look at my portfolio, there are 2 stocks that are down between that are down 80% or more. The first one is Latch, ticker LTCH. This is a company that came out during the pandemic. They went public, and the thesis on them was that they were going to replace key and lock fixtures on the doors of apartments with pads where users could enter the key code. Because over the long term, one of the biggest expenses there are related to apartment security is that the users lose the keys, and so the lock has to be replaced or has to be rekeyed, or when people move out, they have to rekey the lock. So the idea was sound to me. I invested in that stock, and it turns out that they have not executed on that vision, and the stock's down 98%. Not interested in buying it whatsoever. The other stock that's down more than 80% is Fiverr, ticker FVRR. They are a company that was supposed to benefit from the gig economy by matching people with certain skills with companies that needed those skills. And that was something that worked relatively well for a while, but it's not working now. So in either one of those cases, I'm not interested in adding to them at a discount for a potential turnaround. Now, if you want to talk about stocks that have fallen 25 or 30 or 40 or 50%, I can give you several. When Nvidia was down 27% just not too long ago, I advocated buying that, even though I was not buying it at the time because it already makes up so large a part of my portfolio. I've also been advocating for, I think the opportunity for the trade desk is a compelling one. The stock's down 50% on one bad quarter. Are you kidding me? The last time that happened, I tripled my position in the trade desk, and it has since become one of my largest holdings. I think last time I checked, it was out about number 7. 1, 2, 3, 4, 5, 6. Yep, it's still number 7. It's about 4% of my portfolio, and even after that decline, my total holdings are up 268%. And it's that way because the company has a history of execution, because they know their business, they stick to their knitting, they're trying to expand, to take better advantage of the opportunities that AI has to offer. But this is a company that has used sophisticated algorithms to help their customers place ads for a long time. So that's one I would absolutely be comfortable adding to at this point. Again, if it wasn't so much of my portfolio. So Lou's answer, it depends, is absolutely the correct one.
Yeah. The trade desk did a stock split, didn't it? Yeah, they did. Okay.
Several years ago, yeah.
I was just doubting my okay, to your point, since it's down 30%, I was just doubting my spreadsheet because I didn't believe the cost basis. But yeah, that makes sense. Okay. Apparently my cost in it's like $14. So to your point, it's down what, 30 something percent. It's yeah. But yeah, those you don't normally get with 80 and 90% down, but it could happen. And then yeah. So I think you had flagged as something I was gonna say, but to Cyber Mikey, yeah, they said thanks. I have bonds as part of my strategy, but given Tom's feedback about Bitcoin being the new gold, it seems like a great buy and hold. Look, I think that's very much subject to the Giddy's in the eye of the beholder there. I can't say one way or the other. I will say that there are, like Danny said, other ways to hold it, even if you can't do it in your retirement accounts, whether you want to do that or not. But kind of right now, the easiest way to buy Bitcoin is outside of your investment for a lot of these companies. So yeah, do what you want to do, but ETFs at least give you some exposure if you want. Speaking of ETFs, Rose had asked, what are the pros and cons on sector ETFs versus a basket of 4 or 5 companies? Dan, I don't know if you have any thoughts here, but the lazy answer is that with an ETF, you get to be lazy. You don't have to do any work and pick out the 4 or 5 companies. The downside is that you tend to get the good, the bad, and the ugly. Matt had brought up Boeing before. If you had an aerospace ETF, you had Boeing in there almost certainly, and Boeing, that has been a poor choice. If you want to do the work and find a basket, hopefully you're going to pick a basket that you think are going to be the 4 or 5 best companies in the sector. You could be rewarded if you are correct. So it's kind of, I think ETFs are fine if all you're looking for is exposure. Cybersecurity is the one I always go to because none of these companies do everything. So there's going to be a lot of winners, a lot of different niches, but there's a lot of competition. I personally don't have the training or the intellect to figure out what's important from here. So I love the idea of something there. The one risk, or the one thing I'd really look at closely on ETFs, is all of them have to list out their holdings. Some of them, I think you'll find your mileage varies on how true to what they're marketing their portfolio list looks like. Definitely before you buy an ETF, look at the holdings and decide, yes, this is what I was signing up for. Because, look, the perfect example is there was a while that the aerospace parts components ETFs from one of the big names was about 35% airlines, not parts. And, it could work out, it could not. But if I wanted to say, like, wow, I think airplanes are getting used more because Boeing's in trouble, they're going to need more spare parts. I wonder if there's a spare part ETF, and I just bought it, and it turns out that it's like 40% American Airlines or something. That may change my mind. So definitely, I don't think there's anything wrong with using ETFs. Like I say, I think it's lazy can be good if you just believe this sector is the next big thing and I want it. But take the 2 minutes, Google it, click on the actual company that issues it website, look for prospectus, look at holdings, and just say, yeah, this is what I thought I was getting, or wow, let's look elsewhere. I don't know, Dan, if you have any other advice on that, but that's just quick thoughts.
I don't have any advice on ETFs because I have largely avoided them and don't have any expertise in the matter. All right, I want to set the stage before I address this next question. This is coming from me as an individual investor, and I'll tell you why. Samuel Chagozi says, I'm new. I just want to learn more about investing. And I will say, I think you're in the right place. When I wanted to learn about investing and I started researching different ways to learn about investing, and I came upon the Motley Fool, and after checking out several other options, I decided that the Motley Fool was right for me, and I spent the money to become a Stock Advisor subscriber. And I can tell you that everything that I learned about investing from then until now is large part because I learned it here. I am a fervent believer in the Motley Fool. I like having a subscription-based service that gives me a couple of new possibilities a month that I can look at, and I can read the story and decide whether or not I think it's worthwhile. And I can make the investment if I want to, or not make it if I don't want to. I remember early on, and Lou will appreciate this, being a Mercado Libre investor. Back in 2009, when the Motley Fool recommended Mercado Libre, and I read the recommendation, essentially what I took away from it was, this is a company that is trying to do in Latin America what Amazon and PayPal did in the United States. And they were both at the time wildly successful. And I thought, okay, well, we've got a population in Latin America that is twice as much as in the United States. You have a business that is essentially 10 years behind where we were in the United States when it launched in Latin America. And I mean, to me, it was a story stock. They weren't putting up the kind of numbers that they are today, but the story made sense to me, so I invested in it, because the Motley Fool had already done, you know, because they had done the groundwork. I could read the stuff, do the story, and go, okay, that makes sense to me, and do the investment. So I am a big proponent of the Motley Fool Stock Advisor and Rule Breakers, because it helped me become the investor that I am today. And I certainly wouldn't be where I am without it. Lou?
Yeah, no arguments there at all. I mean, one thing I like is that I mean, I came from the quote unquote industry, and I don't. I mean, I think anytime you spend too much time around something for long enough, Danny, but Motley Fool is a breath of fresh air versus kind of some of, like, even if you turn on CNBC and you just jargon to death. I think whether Motley Fool's recommendations are right or wrong, they try to give you a plain English explanation of here's what we're thinking. And that, more than anything, is what I appreciate about the way Fool handles things, because this is an industry, and not Motley Fool, but in general, that you are sold on fear. It's actually, I mean, it's really hard to come up with stock wins, but it's not hard to quote unquote get rich if get rich means comfortable. You just need time, patience, and some of these things. So a lot of this industry is sold as, you can't do it alone. We are the masters of the universe. We know all the secrets. Pay me. And that is, no, that is how it is done. I mean, it's the old joke that the client never gets a boat, but the investment manager has a really nice one, right? Where, and just to the extent that, and again, I always say at the top of the hour, Danny and I, and no one else on here, I can't speak for the Motley Fool, and I'm certainly not doing marketing for them, but just the fact that the idea is like, hey, actually, you can do this. Let me explain to you what I'm thinking, and you can think along with, and we can figure this out together. I just have so much gratitude for the Gardner brothers and everybody involved that this exists, because, like I say, coming from that other side, it is such a breath of fresh air. But yeah, but look, Danny, we don't get paid extra to be nice to them, so let's just move on.
Right.
That makes sense. Yeah. All right. So now I don't know for a fact that this is what's going on here, but I know this is what my wife always does to me and my kid always does to me. So I suspect it. And if so, Shimon, well done. Because Danny, early in the hour, I said, Shimon, okay, we're going to get back to your question before the end of the hour. And I just put in, thanks, Lou, right there as a nudge. Hey, don't forget. I don't know if you were thinking that, but if you did, well done, because yeah, it might be why I remembered. But Shimon had asked, all right, wait, no, let me find it. I lost it now. Oh, voice. But we're talking about stocks for the long haul, right, Dan?
Indeed.
The question is, can you give us a few stocks that are good buy for returns in 5 years? Additionally, what are some stocks not related to tech that you'd recommend? With all the caveats that this is just our opinions and not individual advice and all of that, Danny, we came into this saying stocks for the long term. So I don't know. Non-tech might be tough for you, but let's hear it. Give me some stocks
Okay.
for the long term.
I'll start with the tech side of the coin, and I will let you take it from there.
I'm just going to say Nvidia and Apple. No, go ahead.
Well, and that's going to be one of mine. I might as well just address the elephant in the room now. I think Nvidia is a great stock to hold for the long term. This is a company that cornered the market in gaming processors. They had about 80% of the discrete desktop GPU market, and then pivoted to focus on artificial intelligence. They have about 80% or more of the data center GPU market. They are a favorite in cloud computing, in artificial intelligence, and I think the stock will be much higher than it is, 5 years from now. However, it will be volatile. Let me say that again. It will be volatile. If you don't think you can hold the stock if it falls by 50%, may not be the one for you. A couple other stocks that are fan favorites and large parts of my portfolio. I'll list three of them, and then I'll talk about why. Amazon, ticker AMZN. Alphabet, ticker GOOGL. These two, I think, and Meta, ticker META, these three stocks. First of all, they are all at the cutting edge of AI. They are working hard in AI. And when you look at their valuations, they are much more reasonable than you'd expect for companies that are growing this quickly. And the reason that I advocate these for people interested in AI is because Amazon has a great business in e-commerce. Amazon has a great business in cloud computing. Amazon has a great business in digital advertising. Oh, and it also offers you serious exposure to AI. The same thing with Meta Platforms. Meta Platforms is the worldwide leader in social media platforms. It is the second largest provider of digital advertising in the world. Oh, and it offers great exposure to AI. Same thing with Alphabet. Alphabet is the worldwide leader in internet search. They are the worldwide leader in digital advertising. They are one of the big three cloud computing companies, and they're also one of the leaders in AI. So I think these three companies offer you solid, foundational, established businesses and exposure to AI, which is why I think they are good buys, and they will also offer good returns over the coming 5 years.
Okay.
Lou.
That's a good list. All right. So I'm not going tech. And I need to apologize for regular viewers because they're going to roll their eyes and say, okay, he's just playing the hits again. But we're talking about special companies. I want to give the best of the best. So over 5 years, obviously, my boring little non-tech universe cannot match the sort of returns that Danny was talking about. Like, if there was an aerospace supplier that managed a 1,000% plus gain over less than a decade, we'd all know about it, right? And the fact that it keeps going up. Yeah. Although we have TransDigm, TDG, that did just that and continues to get software-like margins for spare parts for airplanes. I love this business, and I know it's bigger now, and the scale law numbers matter, but I think they'll be the first to tell you that they see as much opportunity now as they did a decade ago. So I think TransDigm, that is a high conviction for me that will beat the market over the next 5 years. Another one that I just can't say enough about right now, AerCap, AER. They are the ones that buy airplanes from manufacturers and lease them back to these airlines that want to be asset-light companies now. AerCap just doesn't make sense to me how the market values it. They have twice bought their biggest competitor. They are far and away the dominant force in this industry. If Boeing wants to launch a new plane, they're going to call AerCap to see if AerCap's going to buy it. They aren't going to call an airline because that's how important they are. They trade at around their book value at a time when they hold airplanes, and used airplanes are in huge demand. I don't think they should trade at their book value, and I think their book value is understated because they don't mark all those planes to market. My biggest fear with them is that someone in private equity or someone is going to realize or going to agree with me, and it's going to take my opportunity away. But I really believe that that's a market beater. And then just for fun, we talked about it earlier, so it's front of mind. I talked about it with Tyler this morning, but Danny, if I told you that a boring old financial service company has returned 2,250% over the last decade, is that of interest? Because you can't get those in financial services, right? Danny, you're on mute. Sorry, but
I am indeed. I immediately think that you're going to say something like Visa or MasterCard.
No, I'm not. I'm not talking fintech either. 2,250% for writing insurance policies on axe throwing venues and marijuana dispensaries. Kinsale Capital, KNSL. Look, we talked about this morning the other way, that it has come down to a valuation that is just, relative to the rest of the industry high instead of price for perfection. So it's on its way down. I hate to predict what the next 6 months will be, but this is a company with 1.3% market share, the best model in the business, and just all of the world out in front of them if they can execute. So there's a few non-tech companies that maybe deserve a place along with Danny's Mag 7 and company. Maybe.
And I could be wrong, but I think we're about to be joined by
Jason's
longtime Fool and your friend and mine, Jason Hall.
Wait,
You have
don't
to
put-
say
don't put
Brookfield
words
3
in my
times.
mouth.
If you just say Brookfield 3 times, I'll appear.
Yes.
Yeah. So.
Don't put words in my mouth, my friends. But Danny, let's close off by saying, since they asked for a 5-year return, we'll be back here February 27th, 2030 on Fool24, and we can see how we did.
Fair enough. Somebody set up a reminder for me.
Yeah. Jason, let's talk about your calendar functions. No, let's not do that.
That's a low blow.
Oh yeah,
No
that
inside
was
jokes here. No
yeah,
inside
yeah.
jokes.
Anyone who has hacked into our Slack, and don't do that, but yeah, you get that. Danny, it was fun. Thank you.
Peace, guys. Jason, I look forward to being on with you again here shortly.
You too, pal. All right, we'll see you around.
Peace, Lou.
Thanks, Danny. All right, as ProShop said, it is contractually obligational. We said Brookfield, and Jason and that hair appeared. Fools, it's the top of the hour. We're going to remind you. We're going to read what that scroll says on the bottom. Jason and I are here to give you our opinions. We are going to give you our thoughts. We are not going to tell you what you could do. We're not going to provide financial advice. We're not going to provide relationship advice. But please do get those questions in too, because I love those questions. We are going to tell you what we.
I mean, I'm willing to give people relationship advice, but not individual investing advice. Right?
The litigation is a lot uglier there. Actually, you don't want to.
No,
do
that's
that.
a good point. Okay, we're not crossing that line either. All right, fair enough.
Yeah.
Okay, so Lou, this is the valuation hour, right?
Yes.
Yeah,
which kind of fits into relationships too, but no, go ahead.
No, I was going to say, like, it actually, Ed kind of set us up later in the prior hour with a valuation question.
Yes.
And I like this question. And as I try to log on, 10 or 15 minutes before I come on to review some questions. And I decided, you know what, let's take Ed's question and let's apply it to some of the biggest, most profitable tech companies out there. So Ed's question, for those that are wondering what I'm talking about, when will an analyst say, yes, we are in a high PE tech bubble? So what Ed is asking for somebody to admit, again, I'm projecting, Ed, I'm putting words in your mouth, but my take of that is you're saying somebody just step forward and admit we're in a bubble with these tech companies, the high PE tech companies. So here's what I wanted to do. All right. And I cherry picked a little bit. I just said, well, what are the biggest, most profitable companies, especially the ones that are tied to AI? And I decided that I just run the numbers. So I'm going to pull up a screen share here. Our wonderful folks behind the glass, if you can grab this screen share and share it. So here's what I did. Started with Alphabet. What we have here is Alphabet's price to earnings ratio right now is about 21 times. Over the past 10 years, Alphabet's price to earnings ratio has averaged about 30 times. All right, Mike. So that's reasonable against this long-term average. I've got some caveats I'm going to throw in, Lou, after I go through this exercise. What about Microsoft, the biggest software company in the universe? I'm willing to say the universe. It's probably just the solar system, but maybe the universe. About 32 times earnings. So roughly in line with its long-term average. It's come down. The stock price has come down a little bit, but also its earnings have gone up. That's helped bring that multiple down. But again, it's in line with its 10-year average. What about Meta Platforms? I mean, they're burning all that cash, right? 36 times is the 10-year average, trades for about 28 times. Apple? Oh, we're starting to see something here. It is well above well above its long-term average. What about Tesla, Lou? Tesla way above it. Now there's some context here. I decided with Tesla that was useful. Its earnings have come down. The auto business is weakened a little bit. Margins are not as good. So profits have come down substantially. They've been cut in more than half, right, from the peak. So part of that, with Tesla's PE ratio, is what's happened with earnings. But again, it's a lot less than its long-term average, 300 times. But again, a lot of that is because it was trading in the 1 comma club, which you don't want a PE ratio to be in the 1 comma club.
Right.
This is the one everybody wants to know, though. What about Nvidia? 49 times trailing earnings.
And
average about. Go ahead.
Yeah. Well, this is something, just to give you another stat. I won't pull up a screen, but just to make the point you're making. All right. Over the past 5 years, Nvidia's stock price is up 1,740%.
Yeah.
Even with the dramatic sell-off post-earnings today. It's still down 2%. But even with this dramatic sell-off, you are still up over 5 years, 1,740%. During that time, Nvidia's PE ratio is down 20%.
Right.
Which
Now,
is kind of the point you're making in a different way. Yeah,
it is. So a couple of things. Like I said, I want to qualify some of that, because on the surface it might look like I'm trying to say, Ed, you're wrong. What I'm saying is it's complicated, right? It's complicated. Here's what we know. Again, looking at those valuations against some of their longer term, and again, we're looking at a decade here, 10-year average here, to try to normalize it over lots of different situations with things that could have affected their earnings that are just maybe non-cash things, but also the environment that they're operating in, like the ad businesses that go through the cycle, like all that stuff, right? It's like trying to give us like some picture. But what we've also seen is that a lot of these companies, their earnings have just absolutely it's not just Nvidia that's seen its earnings go up a lot. Microsoft has been an earnings monster. Apple's earnings are up a tremendous amount over the past decade. They're not up much over the past few years, right? The stock has continued to move up, but its earnings per share haven't necessarily moved up with that. Hence its valuation from moving from well below its long-term average to moving to more in line with its average. But when I say it's difficult, what we don't know, and the reason I don't think any analyst worth their salt is willing to just kind of stand on that firm ground of this is absolutely a bubble, is we don't know what the monetization, like thinking about that Gartner hype cycle, like that's not about stock prices. That's about like the actual business, like the results of the business, the expectations of the results. We don't know how quickly the money that is being spent to build AI is going to turn into earnings per share. We just don't fully know. I think we know what it's going to look like 10 years for these companies, Lou. It's probably going to be a ton of money. It's going to be a ton of money.
Yeah.
But we don't know what it's going to look like in 2 years or 3 years, right? So there's just a lot of uncertainty there.
So yeah, a couple thoughts. I mean, I'm not going to stick my head out either here, but the interesting thing to me, and this sort of gets at last hour, they were talking about short-term, mid-term, and long-term for Nvidia. And, it's funny, like when you break it down that way, and I don't know if you'd agree with this, I'd say long-term, I believe higher from here. Short-term, volatility all over the place. It's the middle term that kills me, or that I have no idea, because we are going to find out in the next few years whether or not that all of this of right now was sustainable and it kept going, or if we were just in the midterm pulling forward some earnings and we just have a baseline for a while. So the middle term is harder, which is sort of a way to get at this too, is that I don't think, based on business results over the last year, that valuations are out of hand. What I wonder is this last year an anomaly?
Will those trajectory of business results continue to earn the valuations?
Right.
Yes.
If we can continue what we have done with this group over the last year, it all makes sense.
Yeah.
And I do believe some of the value is sort of, whether you realize it or not, you're implicitly saying this will continue. The business will continue, not the stock. And
Yes,
I do
right,
think,
right.
and I'm not saying it's not, but I do think the kind of open question or
Mhm.
the two sides of a market right now is at some point the trajectory will change.
Right.
I
Right. Of
don't
course. Of
know.
course.
I don't know if it's now or 20 years from now. God help us all if it is.
I
We're
think
all having boats. But
well, no,
but
exactly.
that's sort of what the PE question
I
is to me.
I think well, and I think like so there's two ways I've been thinking about this, and then I want to invert this a little bit because I think there's a more important question, a more important answer to Ed's question that I think will serve fools better to ponder. What will be interesting is when we start seeing the companies shift their posture on these aggressive capital spends, is it going to be before or after the earnings starts to generate? And that's going to affect the trajectory of the stocks more than anything else, I think.
Yeah.
So I think that's important to remember. So here's how I want to invert this a little bit. Ed, first of all, thank you for this question. I love the opportunity to have this discourse because it's so valuable to have these are the harder conversations, right? It's great when we have a company that reported results and we love it. It's good and the stock's going to go up and we can kind of all agree on things, but the hard things are more important to talk about, to get to the truth and to get to the better answer. And I think the way the average individual investor should think about this is less what's going to happen in the near term, what's going to happen in the long term, is how do we build our investing, how do we use our investing frameworks to get success and maximize the outcomes and minimize the risks in these kind of harder to really figure out what's going to happen periods. And I think the two answers to that are position sizing and knowing your time horizon. For investors who own some of these stocks that have been massive, massive winners and now represent a substantial percentage of their net worth that are Lou, our age or older, meaning they're getting closer to needing to turn that wealth into money. That position sizing thing, I think, is really, really important. Maybe it is time, even if you do believe 5, 10 plus years, these stocks can continue to win, that near-term uncertainty creates a bigger risk to your ability to reach your financial goals. Maybe it is time to think about adjusting that position sizing down.
Mhm.
If you're younger than us and we're in our mid-late 40s-ish kind of window, directionally,
I'll take that.
I'm here to help you make you feel good about yourself, Lou. Then, and you are, but again, you're measuring still multiple decades. Maybe the time horizon is your margin of safety, where what happens in the next couple of years is less of a concern, because you're still adding money and maybe they're not as large a percentage of your portfolio. And if we do go through one of those bad situations where they pull back on the capital spending because the monetization is not happening as quickly and other things happen, maybe there's just opportunities to buy at cheaper valuations, right? And it's not because they've grown into the valuations, but because the stock prices have come down, right? So I think answering that question, which is a hard one to answer, through managing how we invest is probably where a lot of us should be thinking. Okay, I've said a ton in the first 13 minutes, Lou.
Yeah. Well, and I'm just going to add on that one more second. That, yeah, maybe it is a reflection of our ages. I keep going on here. I do have to pay for college in the fall, so I am thinking these way. But look, I want to give, because I know this is a little not taboo around here, but I know it's not dogma. This is your hall pass, people. If you have a huge winner, you are allowed to sell a little and feel good at night. I personally don't have Nvidia, but I guarantee you, if I owned Nvidia, I would have sold some last fall because I did it with a lot of other big winners, with Axon, with companies like that. I love the idea if I'm up some crazy amount by the grace of the markets and whatever else, the best of both worlds, have your cake and eat it too. Take 20%. It can be your cost basis if enough, find other opportunities and still get the upside. So yeah, definitely if you are up there in age, and Jason, thanks for admitting that he tries to compensate with that hair, folks, but he's just as old as I am. But definitely in that situation. But for anyone, go ahead, enjoy your winners. We don't know what will come. If they go up, you still own a lot.
Yeah.
If they don't, you can say, well, at least I got some of it. I like
Right.
that as a mindset thing, but yeah, do what you want.
All right, Lou, we've got some actual like valuation questions that are coming in
Mhm.
here.
Mhm.
Unless you see another one that you want to grab. Do you see one that you want to grab? Let me just ask.
No.
instead of forcing
Go
them into
for
your
it. Go
brain.
for it.
Well,
There's a lot of good ones, but
well, there was the Howmet that cyber. It's the most recent question we've gotten. And
yes.
Howmet, you know Howmet. You cover that. You're familiar with that business a little bit, right?
Yes. So, and we won't go down this rabbit hole again, but yes.
Yeah. So Howmet, ticker HWM.
HWM, and what they are is they are a fasteners business mostly. They want to be other things for other people, but they make the little components and a lot of aircraft engines and stuff like that. And so the 2-second rabbit hole question, the thing here is that they were part of Alcoa. Alcoa, of course, is the aluminum commodity company. Alcoa had this great idea: if we don't want to be so tied to the commodity cycle, let's buy up some finished products, some products that use aluminum. Those sales hold up steady no matter what the price of aluminum is. And so that way we can kind of not just trade with the commodity cycle. Good idea, really poorly executed by a really, really bad CEO. It didn't work out. They split the company in half to go back to commodity and finished products as separate companies. That really, really bad CEO I mentioned, he stayed with the finished products business, and it didn't get any better. Okay. They finally fired him, which is why I can say this. And hopefully I don't think Klaus watches, but if you do, hi, Klaus. But what is left, they
Yeah,
split in half.
for those that don't know, when Alcoa did the split, this was I think they called it Arconic. I think was what they
Yes,
originally
Arconic
called
was the split,
yeah.
and now Arconic has been split into two things, basically
Right.
the aerospace assets and the non-aerospace assets. What we're talking about here is Howmet is the aerospace business, okay?
Yep.
So this is a stock, Jason, not quite Nvidia, but it is up over 100% in the past year. Okay. Now, I would submit to you that while they've done a lot of good things, a lot of that is the moron discount getting taken off. And again, Klaus, if you're out there, please let's do lunch. But change a CEO, competent management, and look what happens. It is literally flying high. That's not going to continue. We have got the idiot discount out. So what we're left with, Cyber Mikey, I think you say it good. It's a really good company. It's got good diversification, but you are right. It seems a little, if not pricey to me, it seems like it's not likely for the multiple to increase from where it is now, because it is sort of trading, and I can pull it up in a sec, but it's trading within range of some of the other companies. They do not have some of the patent protections that a TransDigm do. What they have is huge volumes and long-term contracts. They sort of got caught up even in the AI hype, because they make components for gas turbines, which gas turbines were going to feed the data centers. I think what the other side of valuation is you got to accept some of these, especially industrial companies, as they are what they are.
Right.
And
right.
you're not going to pivot to social media or something like that, which you're going to get a new multiple. I think, and I would say this about much of the aerospace sector, especially in the defense side, a lot of them got ahead of themselves at the end of 2024, and you've seen pretty dramatic falls. And I get a lot of questions on here about these companies like, wow, it's down 20% in the last 3 months. Is it a deal? I don't think Howmet is poorly valued right now, but I think they're valued about where they should be. So I don't necessarily think we are going to see another 100% year. And I think you're going to have to kind of go with the cycle from here. Now, the good news is the cycle looks very strong. We've got a couple of years of airplane sales, the demand for airplane sales, and still not companies that are able to make them at the rate that they need to make them. So I do think this can be a market beater, because I think it's in a good sector over the next 3 to 5 years. I just worry that people look at that chart without the context and see 100% gains. And I would not predict that follows. Does that make sense, Jason, without actually getting into any of the numbers?
It does. I think one of the key things you talked about with Howmet is like the when Arconic was split out, I was relatively bullish on the idea because it should be the value add part of the business versus the commodity side. But yeah, it's like an operating leverage play. If they continue to just be good operators and maximize their scale, it should do well. So, but like I said, this is no longer like the deeply discounted valuation because we don't believe in management. So
yeah. I mean, it's 25 times with debt included, 25 times it's the estimates on an EBITDA basis. That's not crazy, but it doesn't seem like, to me, it goes further. But yeah, at the end of the hour, maybe we'll give that Klaus Kleinfeld's home address and all of that too, so I can really pick on him. No, we won't do that. Yeah.
Let me take Matt's. We got a couple bank questions, so I'm pretty happy.
I know. I'm so excited about this, but Matt's question makes me mad. But go ahead. But
that's okay. So Matt says, "Fools, Jason's right to be hyping Live Oak Bank, ticker LOB, because Live Oak Bank went from a $400 million bank 10 years ago to one holding $11.2 billion in assets today." So, Chip Mahan, is he one of your top 3 favorite bank CEOs?
He is.
He's so great. He really is.
He's just smart.
Yeah. Yeah. And he's the right kind of smart to be a guy that's running your bank. Mm-hmm. He's the kind of smart that's understands the inverted gravity of banks and that you can get all the capital you want. It's easy for bankers, right? To do it. It's what you do with that capital that matters. So I want to talk briefly about Live Oak. And I want to look beyond valuation. So it gets a little bit to the story we talked about with thinking about the big giant tech companies with AI exposure and like that uncertainty hole of trying to invest across that we're dealing with. And I think there's a little bit of that with Live Oak right now. So Live Oak's core business is lending money to small businesses. And their deposit base is largely regular people that just want to get a high interest rate on their savings. So they open an online high yield savings account or a CD. That's been the vast majority of their deposit, the cash that they get from those deposits that then they lend out to small business owners. Couple things. They're working to increase the depth of their relationship with the small business customers and actually become like full service banking partners for them. And they're starting to grow that. That's becoming a little bit larger portion of their deposits. But I like, Lou, that those two parts of the business are different, because if you're a specialized bank and you're targeting a specific sort of part of the market, and that part of the market is not doing well, if those customers are not doing well as borrowers, they're probably not going to be the best depositors either, right? So having a little bit of a separation there is good, and diversifying their deposit base away from their customer base, their borrower base, I think is good. I think also you might think about, well, lending to small businesses, that sounds really risky. Lending is really risky. You can take out that to small businesses part and just say lending is risky, or insert literally anything about lending borrowers and say it's risky, and it is. So some things that they do that are smart. Number one, they know the SBA, like the Small Business Association, loan programs incredibly well, so that they can have as many loans that they underwrite that are guaranteed by the Small Business Association. That's really valuable. That's like if you're a mortgage lender, understanding Fannie and Freddie and making sure that you are, if you're lending jumbo loans, they're not going to be backed by Fannie and Freddie, that you're getting an interest rate and you're getting some loan to value that protects you against losses in case of default, right? So they know that process really, really well, and that's really valuable. They don't just lend willy-nilly. I think they started with vet clinics. Is that where they started, Lou? And then
vet clinics and chicken coops, I think.
Yeah, and they've grown from there and expanded into other businesses. They find businesses that are important, that have pretty good steady revenues, that their customers tend to have good discretionary income, that are resilient to recessions. So they try to get to know those industries well before they ramp up lending into them. So they do some things I think that are pretty smart to manage the risk as a lender. I think right now we do have 2025 for me for Live Oak's loan book, I think is a little bit in the too hard pile because a lot of their customers are not super well capitalized, and between potential trade war, inflation, seeing some signs that that consumers are starting to get a little bit squeezed, that the growth opportunity might be kind of squeezed a little bit for the bank. So I think that for me, because the valuation is not super cheap right now, it's reasonable. For you buy this price and you hold it for a decade, I think you're probably going to be really happy with it. And there's a decent chance you're probably going to beat the market. But I do, and this is just kind of dumb Jason brain here. I feel like there's a really good chance that the market gives us a better price at some point in 2025.
I think that's fair. This is one of my favorite ones to come back to when you talk about the advantage of long-term investing, because I think I see a picture for the next 5 to 10 years for this company that might be different than what a Wall Street analyst who's paid to look at the next 3 to 6 months will see. And so we may have a different outlook, and we are both doing our job, and that is an opportunity. Chip is even older than Jason. And full disclosure, and I'm not really competitive about most people, but I'm competitive with Jason, Matt, as you know. I met Chip for the first time. I don't know the exact date, but it was before the .com crash.
Yeah, and he was still older than you back then.
Oh, he was, but we were selling his former bank.
Right.
We split it off. I was part of the team that split it off, and S1. He stayed with S1. Was it just S1 or anyway? But at the time, he had started Security First Bank, which was one of the first internet banks.
Right.
And they kind of realized, well, banking is for suckers. They sold that off to one of the North Carolina banks and just held on to the technology.
And for those that don't know, the North Carolina banks include Bank of America.
Yes. Yeah. But it was, it was years before that. I want to say it was Centura, but anyway, so I'm really dating myself now, but, and so I met Chip then, and I actually bought into this IPO. So I think,
incredible. Yeah.
So, but that's what I think of him. But Chip has always been smarter than every other banker in the room. And the genius of Live Oak is that we're going to do only a couple of industries, and that is expanded, but we are going to know that industry better than you do, better than our customers do.
Right.
And it works for me. But small business lending, like Jason said, is a tough business, and this is a tough environment. I like this stock over 20 years better than I like it over 6 months.
Yeah, no, I think that's a perfect way to put it. I want to say one more thing about that. Knowing your industry, knowing your business better than you do, the owner of a business in that industry. It's not to figure out where to go say yes. It's so they know where to say no.
Mm-hmm. Well, and
banking,
also
that's what you need.
And also, because it's funny, because I did my due diligence when I was stuck when I had a dog who was sick years ago, and talking, and it turns out like nothing's better than, hey, who's your banker, right, when you're sitting with a veterinarian. But just that would rave about how Live Oak knows what we're going to need before we do, because we are a 3 doc veterinarian practice, and they will tell us, okay, this is what all of our 10 or 20 doc veterinarian practices, that's the products they have that you don't have yet. So that's what I mean, knowing the business, like actually almost serving as a free in-house consultant for a small business, because the industry that well. That's the type of relationship that you just don't drop because someone offers you a penny better on a dollar. So that has been how they've worked. And also, by the way, not to go too off on them, but 3 or 4 times they've won the best bank to work for in the world. They had doggy daycare in Wilmington before anybody did. They let you bring your kids in. They set up daycare for free there to try to get more working parents to come work for them. Just a really, really well thought out company.
Well, in Live Oak, they do a lot of seed investing in
Yes.
financial tech companies too.
Well, the other thing, yeah, and actually that's where I was going to go with the security first thing is Encino, they call it, I think.
Yeah,
but it does-
NCNO is the
yeah,
yeah.
is
Chip Mayhem was the
basically-
founder of that business.
Yes, and that is affiliated. You get that, but some. I mean, a few years ago, they kind of. I think investors missed it. They got ahead of themselves with it because they didn't realize. They basically were running a venture fund in there, and it had a big payday, and it looked like wow, this bank is doing. But yeah, so I mean, there's just this is a trusted jockey for me. But yeah, I really believe in it over the long term. But as you said, that is not a prediction of the next few quarters, other than I think they will walk out of it on the other side of it still intact. And that's what I'm looking for.
Yeah. Matt, thank you for getting that question in. Love, especially with me and Lou both. That's one we could talk about for a long time.
Yeah, I'm getting a little teary-eyed. Yeah, anyway.
So RI Red asks, Jason, what are your thoughts on NTB valuation? So NTB is the Bank of NT Butterfield and Sons, better known as Butterfield Group, is the corporate parent name, but the Bank of NT Butterfield and Son is the banking retail name. So this is basically an offshore bank, Cayman Islands, Bermuda, the Channel Islands, basically a bank for wealthy people, like elites. Offshore banking is what they do. A couple of things I think that are interesting. You look at the valuation, and it's really cheap right now. It trades for less than 8.5 times trailing earnings. I think the earnings are probably going to be relatively steady this year. Dividend yields about 4. What's that?
Yeah, they had a great quarter earlier this month. So yeah, go ahead.
Yeah, and that really, from a valuation perspective, makes the stock look super cheap. And it's cheap, but I think it's one of those that always trades for the low end of multiples. And with banks, you have to remember, banks always trade for most banks almost always trade for a substantial discount to the market, because people think of, well, banks have all the money. No, banks have all the debt, right? So for every $10 that a bank lends out, like $9 of that they owe to somebody. It's somebody's deposit. That's why the deposit is a liability. If you look at a bank balance sheet, and about $1 of that is usually the bank's capital, right? The equity, I should say, right? So banks are very, very leveraged, right? And when we go through economic downturns, people can't pay their bills, can't pay their loans. Banks bear the burden of that. So that's why banks trade for a pretty big discount. But this is a pretty sizable discount, and I think part of it is because there's the bank has dealt with some growth challenges over the past few years that I think it's actually answered in the past, like since it went public 8 or 9 years ago. There was a lot of growth at first, and then during the pandemic it actually didn't do that great. Partly they made some not great decisions with some investments they did. They bought a bunch of mortgage-backed securities at pretty low yields. It's still waiting on the returns. But their fees-based business has grown. Some acquisitions they made to grow their retail footprint. They moved into some markets where their opportunity to provide more high-touch fees-based services have helped a little bit. But their net interest income was up a ton here more recently. But we haven't seen the dividend grow very much at all in the past few years. What's interesting to me, Lou, is that even though the stock price really hasn't done very well over the longer term, they've almost 4x'd their earnings per share since going public. Earnings per share is up about 251%. So it's lumpy growth, but I think long term, this is a really good, steady dividend, high floor, maybe not a super high ceiling business, but it should just be a decent compounder that pays you a good yield. Like I think about this as like long-term, maybe better than a bond. If you're just focused on the income, you're going to capture good yield. Your total return is going to be excess of what you could get from a high quality bond.
Yeah. We talk about valuation a lot, and it's hard to do valuation on some of these, and it is, This is a lazy approach in a way, but it sort of works for me as at least as a guide stick with banks, because as Jason says, it's a pretty simple business. You're buying and selling money. You know, you don't have the annoying thing like factories and widgets and transportation and all that get in the way. So I tend to almost like with REITs, I start with dividend yield and then work my way backwards from there.
Yeah.
And full disclosure, this is one that I added. I think I basically doubled a position in about a year ago. And it is up from there. But this is a bank that I think for all the things Jason say, I don't think it's a no-brainer, but as an income stock or as a mix of income and incremental growth, you know, I think this one works. So yeah, I like that. Jason has just run off, but I can try and get at one. And this is all sorts of trouble. I need input is trying to get me into, but we'll try and think through it together at least as an exercise. It says, hey Lou, I know you're a big AirCap fan, AER. Yeah, we talked about it last hour. Any best guess on what the market cap could be for AirCap in the next 10 years? Gosh, that's trouble. But let's try and break this down and at least do a thought experiment. What I keep ranting about with AirCap is that I think it deserves a premium to book value, but it is only basically trading at book value. So we are going to now, first of all, assume that AirCap over the next 10 years, we won't break that cycle and it will continue to trade at book value. And it might be because look, if you look at the balance sheet, you're going to run scared from this because AirCap, the raw material is debt. So it always looks like it's got a stupid amount of debt. And maybe that does just limit the appetite for on the market on this. But while I can't begin to guess where the market cap of any company will be in 10 years, I can tell you that over the last 10 years, the company has grown its book value at a CAGR of about 6 to 7%. Okay. And that includes, by the way, the pandemic and what that did to aviation then. So I think that that's not, I'm going to hope that we don't have another pandemic in the next 10 years and we have a more normalized rate. But I think that CAGR is achievable because I think the fleets are growing and I think more people are going to do this. So if you just take the current book value, which is, you know, I don't know, about 17 billion on an $18 billion market cap or 18 billion, and apply that CAGR, you're somewhere in the 30s. I don't know if that's accurate or not, because then you're going to have to tell me, is it really, if they can do that, are they still going to only trade at book? But and also there are limits to the size of the aviation industry. We don't know. But again, my biggest fear with this is that I'm not wrong, and some private equity company is going to agree with me, and I'm not going to get a chance to own AirCap anymore. But and honestly, I think that is almost as likely as us figuring out what the market cap is in 10 years. But I just see an entire global aviation industry turning towards these sorts of businesses. This is the dominant business in the field, and it happens to have the best management, the management team that basically co-invented the industry. I like my chances. So very, very lazy, bad, poorly thought out experiment, because I don't know how to predict 10 years into the future. But I think just looking at the last 10 years, maybe. I don't know.
Maybe that is just the most satisfying
Maybe.
answer to give people on this show,
Yeah.
Lou. Maybe.
Yes.
Maybe.
Yeah. Sorry, I need input. I can't give you more there, but that's at least some thoughts on what it can do. And we'll learn more soon. The other thing is that I do think the dividend's going up from here. So maybe that'll finally kick people off the sidelines on the stock, but we'll see. Maybe we'll see. That's even better. Yeah.
Even better. Yeah, even better. So put some window dressing on your maybe. So Logical Dreamer says, how about the valuation of companies like Team? That's Atlassian, the ticker's TEAM, and other small to mid tech. They seem to be very expensive. So I want to say it's interesting what's going on with a number of those businesses, because Lou, if you think about Atlassian, we could put it kind of in the same bucket with Zoom, Asana. Pick a SaaS company, right? And you go back to 2021. It was really like the fall of 2021 that was kind of the peak for a lot of those companies. They started selling off first, And then the S&P 500 peaked in early January of 2022 before we went through the big, the bear market. And during that, 2022 sell-off, before I think we bottomed in September, October, most stocks kind of in the fall, early fall, was kind of the bottom period before the recovery that's made the past 2.5 years so rewarding. A lot of these stocks now look very expensive compared to where they were 2 years ago, right? During that bear market. That's not to say they're not expensive. For example, Atlassian trades for 15 times sales. Full caveat here, price to sales ratio to me is empty calories in a lot of ways, but directionally it can be useful for these companies like Atlassian that are not profitable,
exactly.
right? You're using it.
That's the problem.
Yeah. So that's the thing. Like, you can't use it just standalone. You look at it, Atlassian's generating positive cash flow, trades for 51, 52 times operating and free cash flow. It generates and converts most of its operating cash flow into free cash flow. That's up a ton from where it was. Where you have to think about a lot of those businesses, and Atlassian's not a new company. It's been around for well over a decade, but it's gone through a transitional period, some changes in leadership, and it has started to make improvements, and the economics of the business have gotten better. So it's thinking about that 50 times free cash flow. What are the growth rates of its free cash flow per share going to be over the next 5+ years? And is my holding time period part of the margin of safety where paying 50 times free cash flow can still make that a good result? So I think that's how I'm thinking about some of the Atlassians of the world right now. I don't own an Atlassian. I kind of gave up on them I don't know, maybe 4 or 5 years ago, just because they were really struggling. All of the work and things that they had done, just not making any money. I gave up, and I haven't followed the business very closely. But again, the key is with those sorts of businesses, that's the old saying, right? We're all growth investors on the way up, and then we're value investors on the way down, right? So the framework I use for thinking about the valuation of some of these businesses that still have the higher rates of growth and the bigger addressable markets to grow into, time I think about more as far as the margin of safety. If you're going to overpay for a business, do it when it's still relatively small and has a lot of potential growth ahead of it, right?
Yeah. Logical Dreamer. I don't know if it speaks to my age or just the industries I cover, but I love that a $75 billion company is small to mid. But I think I gave that. I think I gave a $75 billion company as a strong conviction large cap the other day. So that probably says more about me. But
it says a lot about you, Lou.
Yeah. In general, and I think this is definitely true of Zoom because we've seen it with Teams. But so many of these SaaS companies, in hindsight, kind of look like features for a Microsoft of the world. And Atlassian, to their credit, what they do is complicated enough and ingrained enough that so far that hasn't happened. And, like I say, I don't think that they're going to get zoomed to. I mean, gosh, it was bad enough when Zoom became a noun. You don't want it to be a verb now with with what's happened. But I do think that, it's like a constant thing. It's like it's I believe two things, and the combination of them keep me on the sideline. It's a very sticky product that is, even if we're all back to work now, collaboration tools and automating collaboration really, really matters. It's not just when we were all at home with the pandemic, but competition there is intense, and it's only going to get more intense as big tech gets bigger and finds new ways to do things. So that does just scare me away from a lot of these personally.
All right. So you talked about AirCap.
Yes.
So Ed, we got a couple questions here about Brookfield. So Ed, when I popped in earlier, Ed pointed out that he got his Schedule K1s from Brookfield. Yeah, those are slowly coming in. Fools out there, if you own any publicly traded partnerships, I think they have until like March 15th to get those K1's out. So still got, another couple weeks for those. But John Gallego says, good afternoon, gents. John, it is always wonderful to engage with you. Have you talked about Brookfield infrastructure? I feel confident that Brookfield Corporation will hit their price target of $176 in 2029. So a lot of comments there. And I want to talk about Brookfield briefly because I watched an interview that Bruce Flatt did today. He didn't do the interview today, but I watched the interview today that he did with Bloomberg. And one of the things that I think is so important to remember about the Brookfield businesses and the asset management business and the operating subsidiaries is the mental flexibility of its leadership that's bolted onto a bunch of value investors. One of the things that Flatt pointed out is that if you look across a lot of their core businesses, a lot of the investments that they've made, the things that they've acquired, they didn't really exist 20 years ago, right? Like utility scale solar was sort of becoming a thing a couple decades ago. And now that's where they're investing the bulk of their capital. And energy storage did not exist in the way that it does now. Data centers, you look at their Brookfield infrastructure business, data centers for accelerated computing. It's a thing that didn't really exist a couple years ago. That's real infrastructure. That's global infrastructure now, right? So having like the mental flexibility to think about these different categories and places that sometimes we think are stodgy, boring, low growth. Like we think about pipelines and roads, and when we think about infrastructure, and power lines, we don't think about things that are like driving high tech. And having the mindset and the corporate culture, I think, is really, really important for Brookfield Corporation to hit its pretty aggressive price target by 2029.
Yeah, that's that's a call. I mean, I know we don't do calls like that, but but 176, it's what, around 60 now today? So that's ring the bell with, where's our klaxon or something? That's a great, but look, I'm not.
All right, stop it, Kramer.
I'm not going to bet against Brookfield. It's funny. I go back and forth on this because in a way I love the corporation because I do think they're very smart people. We were talking about books earlier, and I mentioned Howard Marks. I mean, if you can bring that guy in house, you must. I mean,
so those that don't know, Howard Marks, founder of Oak Tree Capital,
yeah,
which is I think 75% owned by Brookfield now, roughly.
Yeah. Yeah. And I mean, I just think enough of Howard that if he's willing to hang with you, you must be pretty good at what you do. So,
right.
But in a way, I still prefer the spinoffs because I look at that and like, there's a lot of areas like infrastructure and energy and stuff where I don't want to pick projects and pick winners, but I really, really love having smart people that can, so, so I kind of, I own a little bit of both. And I usually, if I'm going to add to the stubs, but, it's probably to my own detriment because I mean, if my thesis for getting into all of those is, I really think these people are smart, why not buy kind of the company that that houses all that intelligence too, right?
I'm gonna rain on John's parade a little bit here. Of producers, I've got another screen share I'm sitting across here. Don't be too sad, but
No,
what you
176.
What you have to, well, it's not that,
not 179,
right? It's not. I'm gonna assume maybe John had a little finger flub there, but here's the thing. Here's the thing. That's the Canadian shares, not the New York Stock Exchange shares.
Mm-hmm.
So
okay.
So they're not saying that it's going to go from 57 to 176. Notice the single line. That's Canadian dollars. It's not the double line. That's the US dollar. So, still going to be a market meeting. What's that?
I'd still take it. Yeah.
Oh yeah. No, that's still an incredible incredible return. It's 2025, y'all. That's 4 years from now.
Mhm.
And again, they're talking about 16% CAGR, right? So that's you take that in any market environment. You can't look at the past 2 years and say, okay, I got to do better than 16. No, you take 16 every day and twice on Sunday. That's just an incredible result. So, all right.
Do you want to talk lemonade?
Yeah. Why the heck was it up 18% today? I don't understand. I couldn't figure out, and I'm in it. Full disclosure, I didn't spend a lot of time looking for it because I had other actual stuff to figure out, and it was more of a curiosity. Because Lemonade reported the prior day, and the stock actually sold off a little bit.
It sold off quite a bit.
Yeah, it did, and which was interesting because the results were very, very good. The lowest gross loss ratio, and some other fools and people I've engaged with on social media have pointed for good reason. So, what about the combined ratio? When is that going to get below 100%? And that's a really good point.
So,
and the growth rate, like their total growth of their insurance book, the growth rate for their guidance for 2025 is that it's going to slow.
Yeah.
And they're planning to spend more money on customer acquisition. I think that's why the stock sold off after earnings, is they said, well, you know what? We're still going to grow our insurance book about 29% this year, but we're going to accelerate our growth, our customer acquisition spend. And the market said, if you're going to spend more money, we want to see that accelerate too. And that's not what they're guiding to. Okay, Lou, what have you learned?
Well, so maybe you were talking about the weird sell-off post earnings and the weird jump today. You know, the whole weighing machine and voting machine over the last 5 days. It's off less than 1%.
Yeah.
So,
yeah.
which seems
stock.
more.
Yeah.
So it's funny, very different business. But and I'm talking about Jimbo's question is Lemonade a buy after report, improvement in gross loss ratio, but what about combined? So exactly what you're saying. To me, I'm going to compare this to a second, and I know it's not the same, but to another fintech darling, Upstart.
Yeah.
UPST. Because in a way, we're still just sitting there waiting to figure out if the fairy tale has a happy ending, right? We are still kind of waiting to see how
cynical.
Well, no, I mean, look. I all right. So I shouldn't say fairy tale. If the story has a happy ending, because we know they've set up something. They're trying something kind of different. More so probably an Upstart, because Lemonade is more of a marketing story right now, I think.
Right.
But we're kind of just okay. They've done this. We see some signs of good. We have reason to hope, but we're not to the finish line yet where we can say, yes, this works. To me, insurance has always been about two things. There's underwriting and marketing. Okay. And you have to be good at one of them, and you have to be able to at least tread water in the other.
Right.
There are a lot of examples of companies, like Progressive and Geico, who their underwriting is fine, but they win on marketing, right? So as long as you get that one thing going, the other one just has to not fail you. Lemonade is kind of in a similar thing. Like, they have won marketing, but they have to get some people in the room post haste that make sure they can at least survive on the underwriting side. They've done that. They've
five quarters in a row, and the past 2 quarters finally. And below that 75% threshold that they're saying, like, at scale, if we're consistently below 75, we're going to make money.
Right. And they brought in some grown-ups to get there.
Yeah.
And which is good. So they're kind of there. And so now we're just going to wait and see. Okay. They say we're there now. We can scale. If we can scale, we can do it. So they are they're climbing the hill. They're getting there, but the jury is, but we're not there yet.
Right.
And that's sort of like, again, with Upstart, everything is trending in the right direction, but we're not there yet. So is it a buy after the report? I think if you are a long-term holder and you have a long-term perspective, however good you felt about it 2 weeks ago, you should feel better now.
Yeah.
But
if you believe that directionally the improvements in underwriting bolted onto a good marketing story and what seems like excellent customer service, like that end of everything they do, if you believe that directionally that's going to continue, Lou, I think you're absolutely right. Yeah,
Right.
I think you're right. Yeah,
but there are ifs there, and with scale and is when customer service gets into your way too. So I don't think it's settled science.
Yeah. Well,
but
there's one other thing, and your friend and my acquaintance Jeff Santoro dropped in he's coming on the next hour, put adjusted EBITDA guidance in our studio chat. And so that there was a little bit there. I think part of the reason that their guidance was lower was the losses that they're expecting to take based on the California wildfires. I think it was like $20 or $30 million.
Yeah.
And I think maybe there was an expectation that maybe reinsurance might be covering more of those losses. So, I mean, you got to remember all that stuff happened in the quarter they will report next. So they just kind of offered that. So I think maybe that was part of the sell-off. But it is interesting that the stock recovered so much today. But they're saying, in the next less than a decade, they're going to 10x their insurance book, which is substantial. Because if you get to that sort of scale, and all the things they're doing with technology continue to deliver the efficiencies, this could be an exceptionally profitable business and worth far more than it is today. So that's the upside. The downside is
I do think, without going too deep, but just to compare it to the other insurer that I think, Jason, no, you weren't on yet when we were talking Kinsale before the end of the hour, but one of the
I was watching and I was smiling and I was happy. Yeah.
That I don't need to know that, Jason, but none of us need to know that. But one of the things I really respect about them is their ability to just kind of say, okay, now no growth mode because of industry market conditions.
Well, they price risk. They don't price growth.
Right. They would rather lose the business than get into a bidding war for business.
Right. Exactly. They'll lose the business versus writing an unprofitable contract.
And a year or two ago, that was the knock on Kinsale. They stopped growing as fast, but it was a time when insurance were very flush and were aggressively looking for places to put that capital and coming into the E&S. I
want to add one more thing here. You mentioned Upstart because
Well, just
go ahead.
Real quick on Lemonade. I do get a little scared when finance type companies, insurance banks, whatever, start talking about, rapid growth. And not that they can't do it, but just if you're an investor in it, just let's make sure that they keep Kinsale's good advice in mind about
grow the right way.
Grow the right way.
That's
and
exactly
again, not to say they won't. So Jeff, I don't need you to yell at me in the comments, but but just
But to the greater point, one of the things that Lemonade has stressed is that because of their operating model, they believe they can get to those targeted loss ratios at lower premiums than their competition.
Mm-hmm.
Right. Mm-hmm. I think that's the key and we're going to find out, right? We're going to find out one way or another, I think is the key. What I wanted to say about Upstart is the differentiation I have between Upstart and Lemonade is that Lemonade controls its destiny more than Upstart. Upstart depends so much on capital partners and lenders versus Lemonade, which is selling directly to its customers.
Yeah.
So that's we're seeing those customers are far more willing to now actually start using Upstart's platform, right?
Yeah.
So that's
No, I think it's much. I mean, in a way too, Upstart is trying to do something new. Lemonade is just putting a fresh spin on something that's been around forever too. So I mean, in a way, the glass half full is that maybe there's more upside for Upstart because they are. I think Upstart is more of a disruptor.
Yeah, I agree 100%.
Lemonade is basically
just a competitor.
Yeah. They're a tech-inspired marketing company, and again, it can work out really well. Upstart is trying to reinvent the wheel, and
and the evidence is that maybe they do have a better mousetrap. So we can go ahead and mix metaphors here.
And I would say let's finish on Upstart because we're about done, and I know Jeff can't stand.
Well, before you do that though, I do want to just one thing really quick. 307 Fool, are you guys heading to the Berkshire meeting this year? Really want to get to one while Warren is still around. so Jeff Santor and I are planning to go. A couple of other fools I know that maybe are going to go. I'll let them decide to disclose that once they get closer to a firm decision. But I do think there will be some fools there. So yeah, let's keep in touch. Okay,
I would really like to, but I have a high school graduation to worry about.
You have those only happen once. They're not like weddings that happen on multiple times.
Yeah,
so
I thought her senior year might happen twice, so you never know. But just on Upstart, and this is just kind of, instead of going somewhere new, the one interesting thing to me about as a long-term holder now is that my vision on what success has changed so much with them. I have talked myself into the fact that they can't replace FICO. And it's not because FICO Fair Isaac is that good. I think that everybody is going to replace FICO. What has AI done to me?
That's right.
I think that the Capital
It's not the replacement, it's a replacement.
Right. I think that the Capital Ones, the Bank of Americas, the JP Morgan Chases of the world are going to see the ability to score credit as a competitive advantage, coupled with they are all tech savvy, and the fact that with AI you can do more things, that we aren't now in this almost binary race, like what works better, the FICO score or Upstart. What I like about this is, though, if the world moves in that direction and the big banks sort of go in-house, the ma and pa community banks will not be able to follow with their technology stack. So they are going to have to, in a world where sort of the FICO score fades, they are going to need an alternative. If you really want the kind of dumb guy bull case, I really think it's that we could be looking 5-10 years out where the credit unions of the world are looking for a partner who can do this. So
and if you look at Upstart's press releases over the past 2 years, that's what the bulk of the new partners have been, our credit unions.
And years ago I kind of thought this is going to be a one or the other. But anyway, that's we're not even answering questions that people have now, so someone needs to get me off of this, right?
So we should, I think Jeremy Bowman and Jeff Santor are going to be hopping in here any moment now. While they're coming in, Ed asked me a little while ago, what's your opinion on Zoom? I've kind of given up on Zoom. I sold my stock late last year. And part of what they reported this past quarter is the reason why. The growth rates are very low. Their margins are starting to get squeezed. They have all of this cash that they're showing little interest or ability to leverage that cash in ways to create per share value. Like even the stock buybacks, they touted like $15 billion in stock buybacks. They ended the year with more shares outstanding that they had at the beginning. So I really have, I need to see, I will buy Zoom again if they show they can create more per share value. But so far that is yet to happen. So I moved on, which probably means the stock's going to triple over the next 5 years.
Speaking of moving on, we have to say goodbye to the YouTube audience. Fools, hang on for 1 second. You're going to see a nice video clip, and then our pretty faces are going to be replaced by Jeff and Jeremy. I'm going to leave you to decide whether or not that's an upgrade or not. And on that note, thanks everybody. Jason, always a pleasure. And take it away, Adam. Do your magic.